Welcome to the 27th episode of Cartoon Avatars. I'm your host, Logan Bartlett. What you're going to hear on this episode is the long-anticipated crypto debate between Sam Lessin and Zach Weinberg. I'm not sure if this is the best episode we've ever recorded because it's pure entertainment throughout them kind of yelling at each other, or the worst episode because we only really cover one use case and one point over and over again. So I'll leave that to you to decide which one it is, but it's definitely entertaining. I should preface, I did not do the best job as a moderator. I'm reminded of a little bit of the first Biden-Trump debate where the moderator kind of was out of the picture and Biden and Trump just yelled at each other. That's kind of the equivalent of what we got here. So if we're going to do another version of this, I will certainly need to be more proactive in it, but preemptive apologies for that. And then what you're about to hear before that is a conversation I had on Thursday with Josh Wolfe from Lux. Josh is a wonderful thinker, has been a mentor to me throughout all this. And so we sort of talk about the state of the market and what they're doing with Lux. So excited for you to hear that now. Josh, thanks for coming on.
Good to see you, man.
It's
you're like true pro at this. This is super impressive.
You know, I've been at it now for 27 episodes. I think what people are going to hear on the back half of this episode is a conversation, as we were just talking about, between Sam Lessin and Zach Weinberg, which is, depending on your definition, either the best or the worst conversation we've recorded to date. And so this is going to be like the veggies of the dinner, right? You're going to get a little
potatoes, yeah.
Yeah.
Well, I agree and disagree with both of them, so it's going to be good.
Yeah, and so we'll be the nutrients, and then there'll be the empty calories of arguing at each other at the end. But how are things in your world? I guess we probably spoke. It's probably been, I don't know, 2 months or something, 3 months since we spoke. I think it was the end of April, beginning of May, maybe. So what's going on in the world of Josh Wolfe and Lux right now?
All is reasonably well. I mean, we've had this period for 2 years where I probably sounded like a Cassandra, and we had a series of quarterly letters that came out. The first one was basically saying, as an admonishment both to our LPs and to our portfolio companies, capitalize on the current capital markets. This will not last. Raise as much money as you can. Then the next admonishment was husband that cash and don't invest in growth, because that is really the only thing that's been rewarded for the past 10 years. Whether you had negative gross margin growth or whatever, it's just growth. And I think that we're, facing recessionary headwinds and probably going to hit very hard, and investing in growth would be sort of a fool's errand. It's like spitting against the wind. So what can you do with that money instead? You can use it to consolidate your sectors, buy up your competitors, buy up their talent, buy up channels to market, buy up products, and buy the time that you're going to need so that you get a market that reemerges that cares about whatever it is you're doing. So
do you guys, do you publish every quarter? How long have you been doing that, like your updates, and what was the impetus for it?
We've been doing our quarterly letters, for, I don't know, 15 years or something, at least a dozen years. Writing for me is both catharsis and a way to get thoughts out, but it helps to sort of set the guidepost for what we as a firm are positioned and postured. So some of it is poetic, some of it is prose. But it's a way for us to, think in narratives and guide our behavior, and then look back at the stuff that we thought was going to happen and, did it. And then, like right now, amidst a lot of uncertainty, people are pining for playbooks. What do we do? What does this most closely resemble? And everybody's got their analogies from the past, from lived experience, and from whatever history books they've read. I've said this before, but if you were 37 years old, and it's been 15 years since the last real downturn, at least in a credit crisis, you were 22 at that point, 15 years ago, graduating college. You've never really seen an equity downturn. People said, March 2020, there was this big equity downturn. Nonsense. That was a record fiscal and monetary stimulus. But, we were born as a firm coming out of the dot-com crisis. And so I remember both being a retail investor speculating in Pacific Century, Cyberworks, and all these companies that don't even exist anymore, that were up 5x, 6x, and then they were down 80%. And then from that 80% point, right, they went from 100 to 20, they went down another 80%, right? And so they were down 90%. And that was painful, but it was a valuable lesson in what happens when people stop believing or start believing something new. Back then it was going from eyeballs, to suddenly path to profitability and cash is king. And I think the same thing will happen now. You will go through these stages of denial, anger, bargaining, depression, acceptance. I actually think that will be reflected in the structured terms, which you have not seen in companies that you will begin to see. So that means that you will go from firms that raise money at crazy prices, or what will seem like crazy prices, to doing extensions, and then extensions turning into some structured positive preferences for people. So, they get some warrants, some kickers, some liquidation preferences, particularly in the growth rounds. Then you will see people saying, you know what, we're not paying money and investing in these companies and letting these free riders stick around. So then you're going to get something that people haven't seen in a really long time, which is pay to plays. And those will start out plain vanilla, then they'll go 2-to-1, then they'll go 20-to-1, meaning that if you're not participating, your preferred is getting crushed down, to 5% of what it was into common stock. Then you'll see down rounds, and then you'll see full-on recaps. And in this current moment, my view is we're probably Q3 March 2000, to like September 2000. That's what the thing that I viscerally feel this is like. And what happened from that point was you had 2 years of range-bound markets where markets didn't really go anywhere. They sort of came in and out. Then you had the next 5 years, which was basically the rise of the long-short hedge funds and the heroes therein. You had people that were great stock pickers, people that knew how to value businesses, read accounting statements, read financial statements, Ks and Qs, break down balance sheets and income statements, cash flow statements, and understand and reconcile them with what people were representing, and not many of these community adjusted EBITDA and these nonsense measures. In fact, there was a tweet 2 weeks ago or something, and I thought it was a joke, but it went viral, and it's like, what is EBITDA and why does it matter? And I was like, man, there's no better punctuating, moment of absurdity of, people going to relearn these basic lessons. So
I tweeted something to that effect. I think I did what is free cash flow. And then it started to get viral. And sometimes these jokes, they get out of the escape velocity of people that know I'm kidding. And then they start to touch people that want to dunk on VCs. And then it gets out of that orbit. And I realized I deleted it because I started to feel like, one, it was starting to escape that orbit. And two, as many as my LPs probably understand the joke of some of that stuff, it felt like a little tone deaf to even be joking about it right now. But I guess my question to you in all of this is or I guess not in all of this, but one of the things, having lived through that point in the cycle, I guess I have two questions. Like, if I were a founder and there's all this money sitting on the sidelines right now, right? Like, how do you think that plays itself out? Because I think maybe people know this, maybe they don't, but there were a ton of LPs or GPs that ended up trying to give money back to their limited partners, right?
Yes,
and
yes.
I guess I sort of view that as two motivations. One is that the altruistic one is, hey, we can't pragmatically invest this money, right? The more cynical one is, hey, we're ready to restart the carry clock we've invested in these funds, and this was kind of shitty marks, and this fund's a wash at this point. And so we're ready to start over because we're going to call that whole fund a wash. And so let's find a path to getting to the next fund so we can more quickly get into the carry. Do you think we start to see people try to give back some of these big funds, be it, the billions of dollars of crypto money that's been raised, or the $5, $6, $7, $8 billion funds that keep coming out there?
Yeah, I mean, some of it isn't even public yet, but I know for a fact that there's some funds that have raised multi-billion dollars and they intend to give back between 30 and 50% of it to LPs.
Is that right? Okay.
Yeah. So you will see that, and it will be from some prominent names. So yeah.
And do you think how much of that is like, hey, we can't pragmatically invest this, versus, hey, we're ready to restart the fund clock cycle, versus any other machinations that you think exist?
In the case that I'm thinking of, I think it's much more of a pragmatic, rational, this is what we think is rational to deploy. And I think that they think that, their pace will slow, valuations will come down. They will, the interesting thing in this, and to your question of what do you do as a founder? Firms will be investing slower. You'll have less FOMO and the speed with which everybody was going. So that sort of slows down. You will have some LPs that actually slow down. And I've talked about this before about this LP indigestion that's going to lead to the slowing of the champagne falling down the pyramid, that trickles all the way down to founders. But funds will have to increase their reserves because there is greater risk than ever of syndication risk. We are looking through, and I'll share our playbook publicly because, some of these maybe people can replicate, but I feel that Lux is relatively experienced in being able to deploy these. But we are looking through not just to the quality of the company and the management and their own balance sheet, but we're looking through the cap table to see, where's there going to be dead weight. And if you go back to what I was saying before about denial, anger, bargaining, depression, acceptance, and the presence of terms, I can tell you, like, if we have a great peer that's in the cap table, like, we're not going to do anything punitive. But if it's a group that we don't know, like, we're not carrying free riders. And so we're going to put structure in there that if we're taking the risk, and you don't have the means to continue to invest, these people are going to be washed out. And so,
which is kind of the situation of pay to play. Hey, you have to participate in this round. There's going to be structured terms. We're going to support the business going forward and help it get to the next milestone. But if you don't, you're going to get crammed down, right? Is that a fair characterization?
And being crammed down is converted at a certain ratio of your preferred stock to your common stock. And because there is, normally everything is pari passu and everything is great. You go public, you get acquired, everything gets converted, submitted as converted basis. If you are,
which just to say with that, so the shares end up acting, they get converted all to common, and they all act effectively. If you were the Series A or the Series D, wherever you got involved, the share count basically is going to be equivalent from a voting and structure standpoint. And all
right.
That.
And so in layman's terms, let's say that a company raised, and I'm just, doing huge numbers here, but like $500 million, there might be $500 million of preferences. And if the company gets sold for $600 million, then, the 500 million goes to the preferred investors. And so it's not on a pro rata basis. And of the incremental $100 million, depending if it's participating preferred, that might not go on a basis to common, but again, to the preferred on the percentage of the company that they own. So when everything is rosy, structure doesn't matter. And when things, it's something we wrote about in our last quarterly letter, but when things start to get tough and there's distrust between different people with different incentives and different stakes in companies, it starts, to become more zero sum. So in this environment, the other piece of the range bound markets, from 2000 to 2002, and remember, by the way, for people who have only known that markets sort of come back and you got this Fed put and BTFD, buy the fucking dip, that has worked for people, right? And then people have to remember that from March 2000, it took, with dividends reinvested in the NASDAQ, 17 years to get back to those levels. It wasn't like, this is coming back in 2 or 3, 4 years. So you had an entire generation that was basically burned by this, which is why you have, some of us older folk that were basically like, this isn't going to end well, right? And the next generation, 15, 17 years from now, will be thinking the exact same thing. They will remember crypto and what happened. They remember the meme stocks and what happened. They remember, tech, high-flying tech and what happened. And you'll have a younger generation where you need that ambitious naivete that doesn't have any memory. And it doesn't matter if you read about it. You have to viscerally feel lost. You have to know what that feels like. So in this environment, our playbook at Lux is 3 strategies. We've got what we call the bubble, the anti-bubble, and consolidation. And the bubble is not like the old bumper sticker going back to the .com of, please God, give me another bubble. Let me hope that, asset prices will be crazily euphoric, inflected in irrational exuberance. It is actually invest in new cos. So to your point of like, what does a founder want to look for? With 30 months of cash. Give them 30 months of cash. Structure around where 2.5 years, they do not have to worry about the volatility and the vicissitudes of the market. They do not have to worry about geopolitics and Ukraine and food crisis. They don't have to worry about the resurgence of Trump and domestic politics in 2024 election. They can just focus on eliminating technology risk and product risk and ultimately market risk. But we've eliminated the financing risk for 2.5 years. Okay. So that is bubble. Anti-bubble is what we historically have done in special situations. And I'll give you an example of this. So it's like visceral, but great company, great balance sheet, great prospects, probably have to rationalize their cost structure, spend a little bit less, maybe lay off some people, make sure that they got the money to survive, but they got a cap table that's totally impaired. And that cap table is like dead funds. Last crisis, my partner, co-founder Peter Aber, he led an investment in a company called Luxterra. I'm going to get the numbers roughly right. It was a last mile fiber optic cable company. They were selling into data centers. There was a question where we were taking main market risk if we were to invest in this company, with Facebook and Amazon and Microsoft going into all the different cloud constructs that they had buy the product. They had raised, I want to say $100 million. And what's interesting, and you will see the same thing now, they raised it from August Capital, Seven Rosen. Do you know those guys? Most people don't.
I mean,
you didn't
know. I know them from history. Yeah.
Right. History, right? Because they are in history's dustbin. And these were great guys. Dave Marquette, first Microsoft investor. Andy Rappaport, incredible board member, great at governance, right? Something that a lot of younger investors aren't. You had Seven Rosen, Ben Rosen, the original investor in Compaq Computer, gave me great advice when we were starting Lux, but these guys are out of business, okay? Us and NEA came in. Oh, and the other groups that were in there were DAG, I think, and Advanced Equities, which were the boiler room, dial for dollars, dentists, and, which are today's SPVs with these like random people that are eager to get into FOMO companies. So We came in from that 220 post at a 10 million pre. We refreshed management. They were ready to go. We capitalized the business, sold it to Cisco for 660 million a few years later. There's going to be a select few examples of that where you got a great company with great technology and needs fresh capital, and the prior investors are basically going to get burned out because they are either old, can't get an extension, can't raise an annex fund, didn't invest in the succession of their junior partners. And, it's just the natural ecosystem, right? That'll eat it.
I've lived through one of those before. I inherited a board seat when I was at Battery, and it's setting up that structure. It's so interesting how many perverse incentives come to play where, hey, you're a fund that's in a position of strength. To some extent, the founder oftentimes is somewhere between neutral and proactive in making this happen, right? Because they're like, hey, I would rather have one throat to choke on my board or two throats to choke and have them have more ownership. And then I will get refreshed effectively to some level, right? That gets me close to what the last round valuation is. And therefore I can hire more easily. And then you have these older dead weight funds that are kicking and screaming to avoid this from happening, right? And they're trying to raise these SPVs to participate in the pay to play, because you can't say, hey, we're going to fuck you to the weaker investor. But if they don't have money, they can effectively get screwed over.
No,
right.
And
so it's
the litigation is going to go flying. I mean, I would be, you will see law firm consolidation in this wave, but you'll also see a ton of litigation. And, for some, it'll be actually a profitable strategy. The last piece of this, so you got the bubble, 30 months of cash, give them protection. The anti-bubble, take advantage of great companies, but are basically later stage coming in at earlier prices than you've ever seen. And then you got consolidation. And consolidation for us is twofold. It's the existing companies we have with $1 billion or more on their balance sheet. I mean, that's an insane amount of money, right? You take
totally.
Anduril on the defense side, $1 billion plus of cash. They've done their third acquisition. They are going to consolidate lots of companies in the defense, and they will keep getting bigger in the companies that they acquire. So organic growth plus acquisitions, but they've got a killer war chest balance sheet. Icon, EIKON, one of our biotech companies, $620 million of cash right now. They'll raise another $1 billion. You got 800 publicly traded biotech companies, half of them with less than 2 years of cash, 150 of them trading at negative enterprise value, meaning below their cash. Leadership team there, unique time, unique technology, unique team, going to go and pick up all the assets and, get them for cents on the dollar. So we are also looking at other companies that we might not be invested in that have killer balance sheets and killer teams that are going to do consolidation in the sector, because they are the ones that will compound, all set up for that environment where 2 years from now, 2.5 years from now, you're going to have the celebrated resurgence of these long short stock pickers. That's what happened in 2002 to 2007. I think it's going to happen again. You'll see headlines in the Journal, the FT, the New York Times, talking about this guy or girl just made 30, 50, 70% in the month. Why? Because they were short a lot of these companies, and while you got some of the big growth guys who have been, great partners to some of our companies and have been the heroes for the past decade, they're down 40, 50, 65, 80%. And it's hard to recover even from modified high watermarks in some of those cases. So bubble, anti-bubble, consolidation.
That's an interesting framework by which to think about all this. Is there a point in time, are you thinking like when you're making new investments or as you're talking to founders, is it that 30-month period out? Obviously, no one has a crystal ball to actually think about this stuff. But do you have any point in time from the recollection of having gone through this the last go round in 2000, where it was really similar to this, any point in time that you feel like, hey, you can at least feel somewhat certain that there will be funding available for you if Mr. or Mrs. CEO, when you're out there, and at least there'll be a sense of normalcy. You might not like it, right? It could be down rounds and all that. Because right now, at least at the growth stage where I spend most of my time, it feels like most stuff is frozen, right? And a lot of people are saying, oh yeah, we're ready to invest. But you just look, you go through the Axios pro rata, like funded deal announcements thing, and it's really not happening. And I think there's two functions there. One is that a lot of people aren't raising, right? Because they have the amount of money on the balance sheet to go do it. And then two, I don't know how many participants really know what price is even worth in this market, right? When you have these high watermarks and prior rounds and funky cap tables and all that stuff. And then three, I think a lot of firms have kind of taken off these couple months and are just waiting for the market to settle down a little bit when more people go back out and start fundraising again. And so if you're a founder, or as you advise founders, like, is there any point in time that you're saying, hey, here's far enough in the future that at least we'll reach somewhat of a sense of normalcy in the venture
The
market?
30 months for us, the 2.5 years is a function of, it's definitely not in the next year. Like, you need to have way more than a year balance sheet. And generally, because I think everything times pi in life, if somebody tells you it's going to be $2 million to do something, it's going to be, 6.6. If somebody tells you it's going to be 6.4, if somebody tells you it's going to be 3 months, it's going to be 10, so just everything times pi. So roughly, could be 3.5 years, but the more cash you have, the better. Now, you're going to talk to Sam, and I think he wrote a piece a week or two ago talking about cash runways and the virtues of that. So you can dig in with him on that. But I just think that, between 2 and 3 years of cash will let you get through this period where, again, some people are frozen. They're frozen because they're looking at who is the incremental investor. And it was cleared in this construct that I had before of the minnows and the megas, the many large number of small sub-$100 million funds and the few very large and crossover in SoftBank, GC, GA, Andreessen, others that, were able to do these late stage rounds and be price setters, top tickers. That's frozen. And so, there needs to be new pools of capital formed, and there will be, right? People will be going out there and saying the secular trend, the digital transformation of healthcare, the resurgence of revanchist Russia and China demand for new defense, like, people will form new pools of capital and have a good thesis, and they will be able to say, of course, these trends are real and prices are lower. And so over the next year or two, you will have new pools and new players that form. People will leave firms, they'll come together, they'll form new firms. I mean, that's the natural, evolution in any ecosystem. And that will be when you will have fresh, untainted new money that can look at around and a true sort of, if this is a seed or a Series A or a Series B 2.5 years from now, and be a good partner. And by the way, at a reasonable price, not at, going from like I'm leading a company right now, $55 million Series A, we're doing 20 of it. It'll be, that 55 million will last 2.5 years. But when we come out for the next uptick, I'm not expecting like a 10x uptick, right? It might be a 2x. And so,
$55 million Series A. That's quite a big round. I assume it's a pretty special, unique company that
this is, it'll be publicly announced, I think, by September, but this is the result of a 12-year quest to find digital olfaction. And I found it.
Wow. Well, I'm excited to hear that.
Shazam for smell.
Well, Sam, thanks for volunteering. You're and scheduling this on fairly short notice. So I guess people know Zach at this point, but maybe give a quick primer on yourself. What if you had a dating app bio, what would it say?
I haven't had one because my wife and I have been started dating halfway through college, so I've never done that whole thing. But no, I mean, like, professionally, GP of Slow Ventures, kind of got that thing going. We think we've done well. Before that was VP of product at Facebook, reported to Mark, ran a bunch of product engineering and design teams there, including profiles and privacy. Started a company before that called Drop.io. I'm actually very proud. I'm one of the founders of Digital Dumbo. So we were like the second company to move into Dumbo. Turns out I probably should have just bought real estate rather than starting a company there. And started my career, if you go all the way back, at Bain & Company for 2 years, where I did a lot of private equity diligence buyout stuff, which was entertaining for almost exactly 2 years, but not a day longer.
Did Mark Zuckerberg manage the product teams directly?
So there's been many iterations in the history of Facebook's, how they organize teams, right? But in my era, there was a set of product groups that all rolled directly into him. Yeah.
Wow.
Jay-Z had a line about buying in Dumbo in the story of OJ. Yeah, that was you and Jay-Z.
Yeah, no, I feel that line deeply. 68 J Street, it was a different era back then, and totally, I mean, it was wild.
So when were you founding a company? When did you sell to Facebook? How long were you at Facebook?
Yeah, so I started, I to approximately, because it's actually been so long, I'm so old now that I don't exactly, I'm going to get dates wrong slightly, but started a company in 2007. And that was kind of before kids started companies. So we raised money from RRE Ventures, like we kind of were off doing our own thing. I think Y Combinator had just started. It's kind of a weird thing to have a startup in those era. We started literally a file sharing platform. It was just when S3 and AWS were coming out, and we had a point where actually an important Amazon customer. I was on the original AWS customer advisory board.
Wow.
It was like me and a bunch of CTOs. It was fascinating. I had no idea what I was talking about. So we started that. We sold the company to Facebook in 2010. It was one of those things where it was pretty clear that we were doing well. We had millions of users, but it was clearly becoming an also-ran. And Mark just made a very compelling pitch. He said, look, what you're doing is honestly not important, right? Like, it's going to happen. Come work on profiles at Facebook, which is something I cared a lot about and I thought was really important, and identity at Facebook. So kind of ended up doing an acqui-hire thing of that era. And then was there through the IPO, through late 2014, doing, first profiles. And I took on actually doing a big privacy rewrite and trying to simplify the privacy of model for Facebook a bunch. I think we got a lot of good stuff done, but clearly not everything.
And you guys don't know, I mean, you're both New York kids, right? You're both started companies in 2007 in New York, right? Zach, were you in New York or were you in Philadelphia at the time?
We were in Philly and then New York when we started the sales team. And it's really funny to hear and meet somebody who also started a company like when it wasn't cool. Cause I was the same thing. I was at Wharton. I was in business school and everyone's like, you're not going to take the Blackstone interview, whatever it was that people were doing at the time. But we were so New York. I'm assuming everything you did was West Coast.
No. I mean, we probably should have overlapped. I mean, we were very focused in the New York ecosystem. I like back in that era, if you remember, like Birchbox was like started in our office. Muckrack, which has actually become incredibly successful, was started in our office. I gave Venmo their first money and helped them get off the ground. So there's probably a lot of overlap. We're probably like half a degree disconnected somewhere.
Yeah, maybe I'm just like a weird introvert.
But it was a good era. I mean, that was a really exciting time in New York. And it was also kind of fun because New York was so clearly not the cool place to do tech stuff, right? Which I actually liked. It made the community super small. Everyone knew everyone. It was fun.
You know who else was doing tech stuff right around that same time in New York?
Who?
Chris Dixon.
Yep. 100%. I remember Chris Dixon from that era. I was not close with him, but for sure knew him.
Yeah, because there was that small little community after eBay bought his first company that was working on there was a building on 6th Avenue and like 21st Street or something.
Yeah, it's like the app next to Skies. There was like, if you remember like Blip TV, I literally was talking to Mike Hudak this morning, who ended up coming and working for me at Facebook for a while. And, it was a great era. There's a lot of great people who have gone on to do great stuff.
Yeah, the App Nexus team in particular with Brian O'Kelly. I mean, we used to spend hours in Brian's office learning ad tech.
Yeah, well, Brian pitched us on actually using the original, App Nexus wasn't an ad tech thing. It was a cloud computing thing, right? And that was, he was pitching us on using that instead of AWS.
Logan, this is the tech equivalent of Jewish geography.
Yeah, I was gonna say I need to keep you guys away from that part of it, like which camps you went to or something. Let's get back to
which rabbi bar mitzvahed you, Sam?
Yeah,
exactly. It was Rabbi Block. It was Rabbi Block.
You guys are really losing the listeners at this point. No, interesting. I mean, do you guys have? By the way, speaking of New York, I was here, but I was in finance at the time. Is there any ecosystem that you guys have been to that sort of had that similar feel? Because people will be like, oh, Toronto, I heard this last week. Toronto is like New York in 08, 09, or Miami is like New York in 08, 09 or something. Have you guys actually been to an ecosystem recently that had that similar kind of going to break out? You sort of knew it was coming, but you weren't exactly sure where it was going to come from. Is there any city that has that or any ecosystem?
I was going to say, honestly, it's like, I think what's happened is it's gone virtual.
Yeah, I agree. It's everywhere. It's the era, that era was, you had the Silicon Valley group, right? Which felt very corporate and professional, whatever. You had a bunch of New York kids running around. And it was also just like the era of the internet, right? Like, I think, if you think about back in that era, it was like, wow, like you just got PHP and MySQL and things that allow you to scale. AWS is just coming out. All of a sudden you could do shit, right? And like there was a very interesting moment where it was all possible, but it also wasn't like hyper serious yet. Like there was a lot of just silly things going on. I think the problem now is it's big business. And to your point, Zach, I think the other big part is like there's no it's everywhere, right? So maybe there's some Discord server I'm not invited to, but I don't think it's in any specific place.
I mean, I found myself in a weird way. I don't know, Sam, if you guys even care about this. It's slow, but I would listen to a pitch. We would do some homework, do some diligence, and I didn't know I had no idea where the company was based. I didn't even ask.
Yeah, it's not really relevant anymore. But there wasn't, I mean, like I remember, again, we'll stop the New York memory lane trip, but it's like, I remember like, there's stuff like, because the New York Tech meetup, it's like Bree Pettis would like, I have MakerBot #1. And I was like, here's a credit card and how do I invest? Right. And like, that was kind of like, there was just like crazy, there was, what was it? NYC Resistor and like all this weird stuff going on. It was super fun.
It was so early. We didn't know what was going to happen.
Yeah, exactly. There it is. He's getting the digs in early. So did you move cross country for Facebook? Is that what brought you out to?
I did. Yeah. So, yes, exactly. Basically, Facebook acquired my company. The heart of Facebook at that time and now is Silicon Valley. If you wanted to actually be doing anything super impactful in that era, you were going to be in, 1601 and then Menlo Park.
Yeah, makes sense. And so you were there through the IPO, and then take us through Slow's journey. Like, how did that come to be?
Yeah, Slow was interesting. So basically, Slow had initially been just a few friends who basically were all doing angel checks, pooled some money. We're kind of like messing around, kind of investing. So there were three early Slow funds that I think together were about $14 million, right? Like, and this is again, like talk about being early rather than being good. This is like in the era before kids were running on checkbooks largely, and certainly before there was all these micro VCs, right? So we were doing these like super early angel checks. I would seed Venmo and I'd say, hey, let's also put some Slow money in. Like it was very kind of a collective of really just some early Facebook folks who pooled some capital. When I left Facebook, Kevin Colleran, who had actually he was employee 7 at Facebook and then had been a general catalyst, was like, hey, like let's make Slow a real thing, right? And so we went out and raised our first actual fund that was $65 million. And like, we've done a few $150+ million funds now. Our most recent vehicles, it's about $350 million across, a growth carve out for later stuff. But our bread and butter is doing super early seeds from zero. So, we seeded everything from, sometimes starting out small checks, right? They've gotten bigger over time, but, everything from Allbirds to Roman Health, who were the first investors in. We were super early in Airtable. We were super early in, I don't know, like Postmates. We were super early in like a lot of stuff over the last 10 years or so. And then obviously, I think, we can get into this now or later. We also got very active as a fund in crypto in like the 2016-17 era. I had personally started investing in crypto and been super excited about, things like I bought a bunch of Bitcoin like everyone else, not like everyone else, like some people back in like the 2013 era, 2012, 2013. And then, was a seed investor in Ripple, kind of, a bunch of other like Ledger X, like a bunch of early stuff, messing around. And then we kind of got more institutional about it. And, again, like I think some of the most exciting stuff we've done, we were Series 0 seed investors in Solana, which has been a massive win for us. We were super early in Algorand. We were super early in, company, one of my favorites is Clayton, which we're the only American investors in, which I'm really psyched about, as well as a bunch of other stuff.
So what gets you excited about, before Zach goes, what are the use cases? What gets you excited about like crypto in general? Like what is there areas that I know some of those names, I don't know others, but like, is it the different protocols? Is it the application? Is it DeFi? Is it NFT? Is it all of the above? Like walk us through like what your core beliefs are about crypto.
I mean, I'd say that I'm like a first principles guy more than anything else. And I get excited about this idea, when we were talking about what the internet was, early on, I always talked about like the superpowers that it gave, right? You think about, I always say, like, imagine the internet is really just a new bundle of superpowers. You wake up one day and all of a sudden you can talk to everyone on earth instantly for free, right? What does that do to society? Like, what does that do to the world? A lot of, I think that the fallout and the complexity we have, it's like easier to say, this isn't about technology. This is just about new human superpowers being unleashed and what it does to our ways of interacting. Obviously at Facebook, I spent a huge amount of time on identity, which I think is like a really interesting abstract problem area. Reputation, identity, how do you deal with those things in these kind of new superpower context? For me, crypto is really just, honestly, when you get down to the basics, it is just the idea that for the first time, you're basically layering in memory in a distributed, trusted way into the internet. Like the internet was born in a lot of ways, I would argue, broken. And a lot of the problems we have around spam and trust and there's some like very good parts about how the internet was started and some very bad parts. And like to me, the crypto is just like adding a new layer in. We were like, oh shit, like we can also have distributed memory. And there are, again, I'm sure get into this. The question is, what the hell do you use distributed memory for? Who the fuck cares, right? Like, and we can get into the use cases from that perspective.
And what is distributed memory? Even, I guess, to you, what does that mean? Before we get into the use cases, like,
well, look, I mean, right now the way memory works, right? Well, let's take a human context and then a technology context. The way pretend there's no writing, there are no books, there's no nothing. We're just a network of humans that have inputs and outputs and memory on board, right? What is memory? How does it really work, right? You have a bunch of nodes running around interacting with each other. And they're recording their version of a thing, right? And then if you want to know what is truth or what is it, how do you do that? Well, you'd say like, do I have a memory of it firsthand, right? Do I have some sort of onboard recollection? If you don't know, you're going to like ping the nodes you trust, right? There's going to be lots of nodes. They might have lots of different viewpoints on different things, but you ping the nodes you trust. And like, there's a whole game to why do you trust people and retribution and all this type of stuff that bundles around. But that's like a very distributed model. Where there is no single truth on anything. There's only perspectives and then incentives and then ways to pull that together. Now, if you think about writing, right, and a lot of technology over the last several hundred years, there's been this pattern of like effectively centralizing truth or centralizing trust in a lot of ways. And I think if you think about, what a database is, right? It basically is everyone saying like, the Facebook database or whatever, in the abstract sense. It's basically everyone kind of writing to a single store and saying, this is the truth. We're all gonna agree that this is reality. The problem is that as we all know, those are owned, right, by people, by organizations, by context. Like it's a very different model than what we're historically used to in a lot of ways. And so, crypto, is different than this kind of there's 7 billion people, there's 7 billion different memory stores floating around, they like pre-writing the human way of existing, right? But it at least gets us back to some level of saying, okay, like there's a form of ledger, there's a form of memory that can exist where we're going to use a smart combination of math and economics to say that no, there's no one who can just go in and change reality as they see fit, right? And I think that's like a super interesting, abstract, organizational, technological principle. So that's what got me excited. Is like, wow, like start with Bitcoin. Like, wow, that's super cool. Like, there is no central database. That's no one's going to print more Bitcoin. That's a really interesting alternative piece of technology. It's a really interesting alternative organizing principle. And I think when you get into smart contracting and blah, 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 and everything's built on top and, we can go there. It's like, there's nothing that you can do with crypto or really any of this stuff that you couldn't in theory do if you could pull it off with some sort of single centralized trusted node. His problem is you're just never going to actually get that in human society.
There were a lot of things in there. Now I'm like, my brain is like, slow. The creeks are turning and I need some oil. I should have had a drink or something before this.
I got
the Bitcoin thing I always thought was very interesting, right? Because the reason the trustless piece works in Bitcoin is because the data that you trust is inherent to the chain itself.
100%.
Right?
It's self-contained, right? It's a closed loop, 100%.
Right. How do you think about like trust and what is trust and what is the data on the chain when the source of that information obviously isn't coming from the chain itself, right?
Yeah, totally.
Like really, it's a ledger of someone else's data, basically.
Yeah. I think this is if there's one problem in crypto that is the biggest problem, right, that requires the most thought, it's the interface between external data sources and like the internal self-consistent system, right? It's the Oracle problem. It's like, how do you get a digital system to mirror a physical system? By the way, same problem with the internet broadly, right? It's not like this isn't unique to crypto. This is like, you think about like a lot of problems with the internet. The problem is the internet's an incredibly good machine from a self-referential standpoint. But the second you have to sync it out somewhere or it has to represent truth rather than entertainment, for instance, it's really hard, right? And so those interfaces are the key components. I mean, and to me, like there's nothing inherent in crypto that solves Oracle problems, right? That's true, right? Like there's basically two approaches. One is you have economic systems, right, that enforce some sort of version of it has to mirror reality with some smart economics, or people are going to like be basically liable for big losses, right? And I think a lot of the systems you see around like staking and, prediction markets and things like that, like trying to mess around with that. The other is, guess what? You're still trusting institutions. You're still trusting people somewhere in the chain, right? And crypto cannot, as a self-consistent internal system, solve that, right? That has to be solved by other technology and candidly, like by other human institutions, no question.
Yeah. So if we go and we say like, the reason it's interesting is because it's decentralized and trusted in the sense that no third party really controls it. But then we go and say, well, that's true, except for the fact that anytime we bring on off-chain data on-chain, technically we're now trusting the oracle, right? Whomever entered it, whether it was, I think in the mortgage example, it was Kathy in the clerk's office or something. Sorry to Kathy or anyone else. So when that kind of real world impacts, the data comes in and impacts the chain itself, like don't you lose the story? Don't you lose the value?
I don't think so. I think that's too black and white, right? Like the idea that technology fully solves any human problem, I think is like candidly like an overstatement of technology's abilities, right? Like technology layers in new tools and new ways of trading or interacting. But in the end of the day, it does, sort of turtles all the way down. It does always hit back to humans and institutions and how we coordinate, how we act. So let me just kind of dive in there because I'm not really answering your question. Look, here's the way I look at it. There's a bunch of things that the internet in theory should enable that we fucked up, right? In terms of actually getting there from my perspective and getting the value of what it means to be able to speak to everyone on earth instantly for free, right? I think what crypto does is it creates opportunities where we can actually go out and like not necessarily fix a lot of those things, but take second shots at them is almost the way I would look at it, right? So, again, the ones I call out, like you talked about the mortgage thing. I actually think on-chain real estate is an awesome space to be exploring. On-chain hard assets. It's actually something we've been spending a lot of time on as well. Like we've run a Montana land DAO where we literally are buying real world assets and tokenizing them. We have really cool stuff coming with timber, IP, like we're really into this theme. But let me be clear about what I mean when we're doing this and what the point is, right? The way this actually works is we say, okay, cool. We're going to do capital formation in crypto, effectively saying, hey, people can contribute USDC and fund, an SDAO is what we're calling them, right? It's like a pocket of cash to go do a thing. We're saying that crypto can provide really interesting liquidity opportunities for people on chain. And we can get into why that matters in a second. But you know what's underneath? An LLC, right? With accredited investors, right? We're not trying to we're not working around the law. We're not trying to do anything different. We're basically saying like, there's a structure for this. Crypto doesn't change the underlying structure. There's been REITs forever.
So before we get to the actual use case, just so I understand it. So basically you've got an LLC, which is like normal corporate protections, which makes sense.
100%.
People send you money to own a piece of that LLC. They happen to send it to you in USDC, but in theory, they could have sent whatever it is they wanted.
100%.
And then you've got ownership of that LLC. You have an operating agreement for the LLC. There's a manager for the LLC, blah, blah, blah.
Yep.
Okay. So it's an LLC.
It's an LLC. It's like the most boring thing in the world, right? Here's the thing. On top of it, we say, hey, after a year hold period, you accredited investors effectively get tokens, which are bearer tokens. They say, if you own this token, there are 499 maximum possible issued tokens. We say, guess what? You own that pro rata percentage of the LLC, right? This makes liquidity easier, right? If you want to actually do this in the real world with a traditional LLC or candidly a good old fashioned REIT, totally doable, right? The problem is that it's pretty illiquid. It's pretty hard to trade, just like startup equity is.
You're going to let LLC owners or I guess like individual owners of your LLC sell and trade their stake in the open market by selling their token.
Well, they can trade it to other accredited. Yeah, they can trade it to other accredited investors, which by the way is like what you can legally do, right?
So how does that work?
In terms of what? Like practically, how does it work?
So I have a token and I have the key. I have the security key. Maybe I keep it in a lockbox or I store it. Where do I store the key?
Were you talking about like your wallet?
Yeah.
Yeah. It's wherever the hell you want, right?
So I store it in a wallet. I store it in my own wallet, basically.
Sure.
Okay. I store it in MetaMask or what, Coinbase or whatever, basically.
Whatever you want. That's the beauty. It doesn't matter.
And then Logan wants to buy it from me.
Yep.
And so how does that work?
So if the easiest way, right, is Logan, and there's a bunch of companies that are starting to work on this. So we're front running this being a major thing, but it's certainly happening. Because these public blockchains are all public, Logan put up a thing and say, hey, I would love a share of this LLC, right? Here's my bid, right? And you can be like, oh shit, I want to hit that bid, right? Like I'll sell Logan my LLC share, right? And all of a sudden you can do it on crypto rails, right?
Let's stop there for a second. Logan wants to buy the token. Why?
Because it is a financial asset that can appreciate because in the case of something like Timberland, it can be income producing.
Right. So he wants to buy it because he thinks this company is worth something. Does he have access to the financials?
He cannot. I mean, that's completely up to how you want to manage it.
Assuming he's a sophisticated investor, and this is Logan we're talking about, so clearly that's not true. But assuming he was a sophisticated investor and he wanted to buy one of these governance or whatever ownership tokens, he's going to want to know something about the company, right? He should know like your assets and your income and what you own. So how does he get that?
The cool part is some of that stuff actually can be public and on chain, right? So for instance, take a Timber DAO, right?
You mean like just a database or an Excel file that you share?
Let me explain to you exactly what I mean, which is like take like a version of a Timber, there's a Timber DAO, right? So we stand up one of these standard old LLCs, we wrap a DAO on top, right? And we say, hey, good news, it's Timberland. Every year it's going to produce income. And the way the income resolves, right, is the LLC takes it in, turns it into USD, sends it to all the token holders, right? Does it for 10 years, does it for 20 years. That income flow, right, is public. That's cool, right? And like queryable, and you could do that at scale. So that's one version. But I think, Zach, the thing I'd say more broadly is like this question of like what information access you have or don't, it's like, there's no different than the world of startups, right?
I'm struggling with what is the difference here between this and what you can do with a startup or with a REIT.
Friction and therefore liquidity, right? There's the thing that you get out of something like a crypto ecosystem. Like, by the way, let me step back for a second because I'm sure it'll be Zach's next point. In theory, you could absolutely do all of this if the federal government stood up a server everyone trusted and said, hey, guess what? You can register all your LLC shares here, right? In some way, shape, or form. And if you want to trade LLC shares for not just the 2,000 publicly listed companies or whatever, but for literally any company, right? With some basic requirements around it, totally could do something. It'll never fucking happen, right? And since that will never happen, right? For a whole bunch of reasons we can get into, this idea that you can have a platform which is like, look, the transaction costs on flipping around, long tail assets and long tail equities, right? In any sort of like papered way with DocuSign and lawyers and any sort of traditional LLC shares, it's a complete nightmare. It's too expensive, right, to even make it worthwhile. With what you get is the ability to say, look, we'll drop transaction costs of actually doing all this stuff to zero. We have bearer tokens, right, which represent real equity and real cash flows and real underlying ownership, as well as some governance stuff we could get into. That's super cool.
Okay. I just want to make sure I walk this through. So I am aware of your token because you've posted your private financial information to the public blockchain about how this works and the amount of money you're making. So you've basically given up a bunch of your corporate secrets to the public.
No, necessarily. Zach, just to back up for a second, and I don't mean to cut you off. I just want to make sure we're on the same page. You can the example I give you about income flowing through the chain, I think is actually a pretty cool and easy one. You can build a track record, blah, blah, blah. That's kind of a side. I don't know.
Well, you can also fake it too, but that's a whole different story.
You can fake anything. Like, that's why
well, no, you can't fake like audited financial statements because that's what an auditor is supposed to do. But you definitely can you can fake like income on a blockchain because it's not audited. But let's assume for a second that doesn't exist.
Whether or not, given what's happening right now at Ernst & Young, whether they can fake audited statements is another question. But the basic point of...
Sure, let's just throw out the whole auditing industry, because like...
Well, but let's be clear that everything comes down to trust, right? And my point is there's no such thing...
No, it doesn't come down to trust. It comes down to legal protections and rights in the court system. When you don't send me the money or you faked your financial statements, I get to sue you. I also get to do like a whole bunch of homework on you.
To be clear, Zach, there's zero difference between what I'm proposing and we're talking about. And the only thing that crypto adds, which is the key component, is dropping transaction costs to zero. Your point about audited financials, like, look, of all the assets and companies in the world, right? The percentage that afford and do fully audited financials to the like standards of, NASDAQ, right? Into some of these registered, tiny, right? Like actually most assets in the world are not publicly listed, right? That stuff doesn't exist for them. It doesn't mean they don't trade. That doesn't mean they're not valuable to have access to, right?
Well, yeah, like if I want to go buy, I agree with you. Like if I want to go buy a share of a private LLC that owns some real estate, obviously it's not like a listed asset.
Nope.
And I've got to go do my homework because I want to make sure.
Diligence. Exactly. And that's what.
There's a lot of things I want to make sure when I'm buying a share. I want to make sure that it exists, that it's real.
Yep.
I want to make sure.
Which, by the way, blockchain solves for you instantly.
That's not true because you can put anything on the blockchain and not have it registered in the real world. I need to make sure the actual LLC exists, that it's governed.
Oh, yeah. You need to make sure that the connection between the token you're buying and the underlying LLC is sound. Absolutely.
Right. So I need a lawyer and to do that and to check it. I need to make sure that the income stream history is real and not faked. Right. So I have to do like auditing work on the financials themselves.
Yep.
I should. Maybe let me take the word I have to and I replace with I should. I need to make sure that the token that I'm actually buying is real and owned by the person who is selling it to me and hasn't been hacked and listed.
Again, I would say marginally much easier with crypto than any other system. Not perfect, but way easier.
Not if you make a mistake and you buy a stolen token and,
Sure. Again, that's life though, right?
Well, it's not life actually, right? Because like lawyers take on. No, because if you go to buy stock in an LLC and the lawyer representing the group who's selling it to you actually like faked it, like guess who shows up? The police, the courts. I mean, there's a reason we have these protections in place.
I think your perspective or how these transactions are generally done and the number of layers between people is like very overstated, right?
I still want to go back to the basics. I buy the coin. Let's assume we've done all this work and we believe that this coin is tied to the LLC and that the LLC is real and it's run by real people.
Yep.
Just like a normal LLC. I'll give you all that, which makes sense. And I buy the coin. What legal document do I sign?
You don't need to sign. Well, actually, let me be really clear because the way our structure works, there's two steps to this. To take possession, to buy it, right? To take possession of it, there's no illegal contract you need to buy. Just as, if I sold you this Apple Watch, there's no legal contract. I give you the Apple Watch, you give me cash, right? There's nothing you have to sign for that. Now, if you want to get access to the downstream income from the LLC, right? Like the way we're going to go do a dividend, if you want to vote in governance, you actually need to go through KYC AML with the underlying group again, right? So it's not like we're saying so in the end of the day, you do have to re-register with the LLC before you're going to get a dividend stream off of it or whatever, but you could hold it and not register if you wanted to.
Why would I want to own the coin without the future income stream?
Again, it can appreciate. You can't take receipt of the income stream, right? Because we can't touch things like KYC and mostly anti-money laundering issues, right? So there's
I actually have to.
Token share doesn't necessarily appreciate in terms of the income streams. Do it. It doesn't mean that you couldn't trade it again. Things like that.
So I can speculate on it, but I can't actually get any of.
Speculate's a loaded word given this month, especially, right? Like you can invest.
Sorry, I can trade this coin of which I have no legal right to the underlying income stream.
You do have a legal right. Again, you have to.
But you just told me that I don't until I go and do all of the KYC and something.
It's just like a bearer certificate, right? Like it's literally just like having a school bond.
What we're saying is that the token owns this thing. Let me ask one maybe simpler question then. So you guys get some income from a real estate property you own. Mary pays you rent.
Sure.
She sends you the rent in US dollars because
goes into the normal LLC.
Because she's a normal person. And she sends you that money into your Chase bank account in US dollars.
Well, to remind me of the LLC's Chase bank account. Yeah.
Yeah, sorry. You being the LLC. That's what I mean. To the LLC's bank account. And then you now have to change that from $1 to a USDC. And then I have to, okay. What happens when you don't send me the money?
Who is you in this case?
The LLC that of the coin I own, but I don't have any legal document signed.
It would be the same thing as if you're a shareholder of a company and the company decides to not honor its agreements. You just sue the LLC.
But I don't have a legal agreement with you. You just told me I didn't sign anything.
The token holders do. The registered token holders absolutely do. Right?
So what? No. So wait, hold on. So I buy the token.
Yep.
And
that
along
gives you the right to register with the LLC if you choose. right?
And then I sign all the legal documents that show I actually own a piece of this LLC.
Correct.
So where did we just save on transaction costs?
Well, you save the transaction costs because the actual sending back and forth of like, I'm trading you this watch for some USDC, right, is seamless. The posting to an exchange to actually
But that sending of
can't buy.
But sorry,
Figure out like Kenny can't buy.
you don't send
No way right now, Zach. If you
when you buy a share, let me be clear. When you buy a share of the LLC,
Yeah.
you're not sending me a physical box of the LLC in the mail, right? Like it's a ledger that the attorney for the LLC keeps, of which I have a legal document that says I own a piece of it. So where are the transaction costs that you're getting?
The way that this works, they're bearer shares, they're bearer tokens, which is the key. Whoever has the shares, those are the unit owners, right? That cuts out a huge amount of crap.
According to what document?
According to the formation of the LLC and the agreement signed when you set it up.
And what happens when the LLC doesn't send the money?
The people who own the LLC sue it.
Right. So I'm still like lost. Like I ultimately, for me to have a claim, let's just go through the actual bankruptcy process here. Like for me to have a claim on the income that you were supposed to pay me when I bought this coin, right? I agree. I can buy a coin over the internet. Take me 4 seconds. Now,
yeah, and it's way more efficient than any possible way you can buy a share of an LLC right now.
Well, that's part of what I'm not 100% sure is true, nor is that necessarily like an important problem.
Well, but like, it actually is a very important problem. It actually argues one of the most important problems that we face today. Is
look, when I buy something,
liquidity in assets.
It's not about liquidity, right? It's about protections and rights.
No, it's about liquidity.
So like the reason it takes a little bit of time for me to go and purchase a piece of an LLC is there's a LLC operating agreement, right? That I need to do diligence on and read to make sure that whatever it is I'm buying is legit. I have to look at the financials. And then there's an equity purchase agreement. And in the LLC documents, it can be like a profits interest or whatever, but there's an LLC there's a purchase agreement. It's a legal document that I sign.
Yeah, and that's the thing that with our structure, for this one example, there are 5 more we're going to get into, I hope. This is an example where that is the piece, the purchase agreement, the market making, the transfer that crypto has leverage on that's massively valuable.
But when I buy your coin, do I sign a purchase agreement?
You don't need to.
So you're telling me, and I just want to make sure I get this. I can buy your coin.
You need a purchase agreement to buy this iPhone, this watch from me.
But you're not telling me that watch is going to deliver $1,000 a month.
Doesn't matter because you're an accredited investor, right? And
accredited investor has absolutely nothing to do with the fact that you cannot send me the money.
It does actually really matter because here's the thing. Let me just try to explain this to you because I think it's very important to understand. And it seems like we're missing each other. There are lots of things in the world. Most things in the world are transacted without purchase agreements. Do you agree with that?
When you take physical possession of the thing, and that is all you care about.
Do you agree with that statement? Do you agree with that statement? Because in most things in the world are transacted without a purchase agreement.
Most physical objects that aren't about a future promise.
I'm saying things. Most transactions by most people are conducted. There's no purchase agreement when I go to dinner. Is there a purchase agreement when I go buy dinner from someone?
Because you ate the food.
Well, but that could be argued.
They're not. If you show up at like, Del Posto, which is closed now, and you're like, hey, you owe me 17 future dinners. Guess who's getting a contract? And Del Posto.
Really clear. You're conflating things, which I'm
conflating the difference between a one-time transaction and a promise of future cash flows.
I'm sorry. There's no promise of future cash flows for owning a piece of an LLC, by the way. That's another thing you're conflating. You buy an asset. You buy anything.
I'm buying this thing without a promise of future distributions?
100%. Do you know how many equities, even in the public markets, you get future distributions from just out of interest? Almost none, right? It's a promise of maybe someday some profit. That's actually how most equity markets work, right? So this conflation where you're saying, oh, no, it's different because you promised me a cash flow. That's bullshit. When I invest in startups that I do all day long, maybe someday I get paid back on the equity value. Am I buying it because I think there might? So the thing you got to step back and understand here, right? The beauty of the crypto system for doing something like this, right? There are tokens, which are pretty damn hard to fake. You do have to do your diligence. They're real, 100%. You do have to do a bunch of diligence on what you're investing in, right? 100%. But it is literally just like buying in any other form, an asset or anything you can buy. Where, by the way, this idea that, there has to
be... So Sam, you're telling me, so I got to do all the transaction costs of homework. not the like actual transaction.
Find things in the world.
Right. I got to do the diligence on the company. I got to do diligence on your financial statements. I got to do diligence on the LLC. I got to read the operating agreement.
If you choose to, I invest in tons of companies with none of that diligence, but if you choose to, you have that option. Yes.
Yeah, I mean, if I'm going to buy an established LLC and trade it and do all, like, I might as well probably check to make sure all those things.
But again, it depends on how you value your time and how you value the trust of the people who otherwise hold it. I mean, the reality is talking about equities. It's like, you think most people buying a stock go and do all that homework? Absolutely not,
because they're registered with the LLC and they have to file financial statements. And there's like layers of regulation that force them to do real things. And that's what actually, by the way, that's the whole point.
Let's be clear. What those layers of regulation do is make those securities relatively, setting aside 70% sell-offs and where the market actually trade these things, for retail investors, very safe. They also make them very low growth, right? They make that available to a tiny sliver of the assets in the world.
Sorry, right? You're telling me, no. Let me just unpack that.
Assets, sorry. Public in the
you're telling me that the SEC rules make them low growth, which is like, I don't know.
Rules are onerous in a way that protect retail investors at the cost of making it almost inaccessible for almost every company to access, right?
Being a public company is hard. I agree with that because the bar to not scam people is high.
Fewer public companies today than have almost been in all of human history strong in the last 50 years. That's why, right, you end up with a world, by the way, where those assets are massively overvalued because they're the only liquid things people have access to. Right.
I just want to go back to,
there's an illiquidity discount cost to everything else. Right. So
I just want to go back to the coin transaction because, like, I don't want to conflate public equities with private all this stuff because I feel like we're in crypto solves this land, and I want to go back to the actual how does crypto? Well, hold on, wait, one specific question. Okay.
Yeah.
Assume I do all my homework, or I'm like an idiot and I just want to buy this coin because Sam says it's cool, right? Like I buy the coin. I buy this bearer coin, which I really want to unpack here for a second. I've already incurred all my like homework transaction fees. I buy this bearer coin.
Just by an Android phone or an iPhone, you do some homework.
Yeah. So you've told me, Zach, this bearer coin is an owner of this LLC and has rights to the future distributions of it. That's what you've told me. Now I've purchased this coin via a wallet that I own. Okay. Coin comes to me.
Buy the wallet, but you custody it in a wallet.
Sorry, you're right. Yeah. I sent you USDC. You gave me custody. Totally understand. That makes sense. Okay. Now, you don't send me the money.
Who's you?
You're the LLC. You have always been the LLC this time. Like, so you send me you told me you would send me the money.
To be clear, there's a distribution. Let's be really specific what you mean. There is a distribution coming from the LLC to the owners of the LLC.
Correct. And you just like, don't do it.
No, does it send it to no one? Does it send it to some
like, how about this? You get in a fight with me about crypto on a stupid cartoon podcast, and then you decide Zach is kind of a shitty person. I don't like him that much. And now I'm going to distribute the rental income I received to everybody but Zach. Because fuck that guy. I don't really like him.
You just sue me in normal courts.
Okay, so now I take you to court, and I want to go through this. I go to court. I hire an attorney.
To be clear,
wait. The attorney. I
want to clarify one thing, which is important. It's not impossible, but it's a hell of a lot harder, right, with crypto than with other systems to say, "Fuck that Zach guy." It's potentially easier to say.
It's literally not true because you control the bank account and you can do whatever you like.
No, that's wrong. Let me explain why. It's like the money flows from a traditional bank account into USDC into the DAO. Okay. I could say, and that is actually how distributions go out.
No, I get it, but like stop right there for 1 second.
Yeah.
You put the money from the LLC bank account into the DAO, right?
Well, this is my point, actually. This is why I was asking you a very specific question, which is your problem that I sent it to no one, or I just sent it to everyone but Zach?
Look, whoever controls the bank account can do whatever they want.
Well, no, that's like, again, I just want to be really clear. That is, in the most abstract sense, true. But when you get into crypto, actually, you get actual additional guardrails for free, which is that it is way hard. It is easy for the person who owns the bank account to say, fuck all the LLC members, right? Like, I'm not going to like put my USDC inside to anyone. I agree with you. And then, by the way, all of the owners of the LLC go and sue the shit out of the person who's administering it and doing that, right? Normal court system, no advantage there, but like whatever. The scenario you pointed out is somehow I'm mad just at Zach, right? But not at all the other like LLC members. So I somehow just target him. That's actually reasonably hard to do. Not impossible, but maybe
Okay.
I have to fork something. I have to go do a Celsius weird shit where
Let me just start with like, look, angry, vindictive, clever people are angry, vindictive, clever people. And this is how people get screwed.
Crypto changes none of that.
Right. Exactly. And so
Agreed.
you decide not to somehow, because there's like probably 30 ways now to do it, because you could do it at the bank account level and you can do it at the DAO level, to not send me the money. And then I go and I have to sue you. I agree with that.
Sure.
And I hire an attorney, and the attorney says, this is really interesting. Can you send me the purchase agreement that you signed for your shares in the
Don't need it because you have a bearer token. And that'll stand up.
In what? Okay, I have a bear. What does it even mean?
It hasn't been tried yet. You're going to need to bring it through the courts. I agree with you at some point, but there's a lot of things that work like that, where the reality is the first.
What am I showing the attorney that I own?
Your transaction on chain and your access to the wallet.
So I'm walking.
The idea that you're pushing that for some reason courts will like completely disregard that. Look, you might be right. There's going to have to be case law developed about it. I think it's extremely unlikely, right? And that's a system. I think that again, like if that's your key pressure point, is courts will never look at digital systems and understand digital bearer rights and transactions and who sold things. I think that's a pretty weak argument.
That's not my argument. This is my actual argument, which is we've walked through kind of like, basically, you have to do all the same homework, all the same diligence, all the same checks. Also, by the way, we now have 2 layers of places where you can screw me over, because we have the bank account and a DAO.
We can get into that. I think it's a lot less, but we can argue. I think that's a minor. Yeah,
take it all the way back to the beginning, which is you said cheaper transaction costs.
Totally.
How in the world is this going to be cheaper transaction costs?
You have a bearer token for an LLC I want to invest in, right? I want to invest in it not because I've read every single line of every rule. By the way, I bet money as a professional VC and a lot of people on the table, no one reads every line, right? Like, so the idea that there's this perfect diligence in the physical world that goes away is bullshit. But I want to invest in it. Like, I want to invest in it. A bunch of people I trust are invested in it. I've heard a lot of great things. I saw some cool analysis of it. I want to invest in it. The idea that I can basically broadcasting, I'd like to buy it, right? Every person that's a holder can get a message and say, oh, I'm interested in selling, hit a bid and transact in seconds, versus going through a bunch of lawyers and paperwork. Not to mention to figure out who the hell even owns the thing in the first place and who to talk to. Like, I literally do this. I'm sure you have too. Go try to sell private shares on of a startup. Let's make this really easy. It's a complete pain in the ass.
You know why? Because the company prevents me from doing it because they have legal documents.
Zach, that's completely wrong, right? It's not because of the company, but I have plenty of agreements and I invest in plenty of companies that are free and clear to transact. The problem is that there's no server in the world, right, where this stuff is all registered and easy to message around. Crypto creates the opportunity to create that. And that's a massive deal. If you don't
but that's just not true. Like, it's just simply not. No, it's not, because the reason this stuff exists is because if you want to buy my token in a company or my equity ownership in a company, you want to have financials of that company.
Zach, again,
I'm sorry. It's bullshit to want to understand the underlying financials of the thing I'm buying.
Zach, it's bullshit that's your argument. Right. It's bullshit because that's like being like, I would challenge you. It's such an abstract argument, because it's basically saying like,
it's the opposite of an abstract argument. It's a specific argument that, like, if I want to buy something, I need to know what it is.
Your model of the world that you're putting out as like such gospel is that somehow like every company in the world has perfectly audited financials that everyone accesses before they buy things. And that's complete bullshit. Right? Like, that's actually that's how almost no companies in the world function.
No, I'm not suggesting they have to be perfect.
The public markets are a tiny section of the asset base of the world. Tiny segment.
My suggestion is that even private companies, startups, ones I've run multiple private companies. I own shares in private companies.
Do you audit financials every year for every startup you're invested in?
Of course not.
No.
But if I'm going to...
Do you even have financials every year for every company you invested in from zero?
I have legal rights to them.
No. I invest in companies all the time that have no financials because they just got started.
No, totally. Of course, but you're not talking about... Sorry, because if I'm going to purchase something at any point, I want to understand the thing I'm purchasing.
Yeah, to some degree. There's a spectrum, right?
Right. But you're suggesting that you're putting up real estate coin, right? And real estate coin is in some public ledger somewhere.
We'll call it let's call it a specific REIT coin as an
REIT
example.
coin. Okay. So, like, for me to purchase this REIT coin and to know what it is, I still want to understand the same things, whether it's a coin or not.
Understand something.
Right.
What that is going to be very dependent on who you are as an investor, what your thesis is,
Right.
like who else is involved. Like this idea that, oh my God, like there's not perfectly audited financials up to the standards of like a public company and therefore it's bullshit is crazy.
Okay. Let me walk through and then we can move on from this one because it's so crazy.
We can keep going. I think you're really standing up a straw man here.
It's not a straw man. It's actually the opposite again of a straw man, which is very specific use case of like how this works and why it's better.
I've given you a very specific version of the very specific thing crypto gives you advantage in, which is
let's just create two different entities and do the exact same thing.
Sure.
There's two LLCs. Yep. One is a normal LLC that owns like a shopping mall in Wyoming.
Sure.
And the other is a normal LLC that owns a shopping mall in Wyoming, except it's like run as this DAO thing, right?
It has a DAO wrapper on it. Sure.
It has a DAO wrapper on it. Okay. So they own the underlying assets. It's still a legal entity. It's an LLC. It owns the underlying income. There's an operating agreement.
Yep.
That LLC has that governs the actual operations and like who's supposed to own what.
Sure.
There are owners of this LLC.
Yep.
And each one of those owners signs a legal document that says, I own a piece of this thing. I have either profits interest
and
or an
that's
actual...
how this thing start on day one when we incept these things. That's basically how they get set up. Correct.
Right. Okay. So there's like legal rights, legal ownership for the people. So we've done the same thing.
Yep.
Okay. And now what we say is we have this problem we're trying to solve theoretically, which is we want to be able to like freely trade the ownership in this.
Friction that trading these units to be way lower, right? Because it'll make them more valuable, right? Because liquidity is valuable.
Okay. Well, they don't.
Let's liquidity benefit and an illiquidity discount. That's how the world works. Because if I can trade something, it makes it more valuable for me to own it.
Okay, but it doesn't change the underlying cash flow from the thing. So this idea that it makes it more valuable is a whole separate speculative question that is...
To be clear, there could be zero cash flow. It could be this thing just...
Well, let's just do the thing. Like normally humans like to buy something because they're going to get future cash flow.
In theory, except for the fact, again, the public markets, we'd argue there's almost no actual dividends to shoot out, right?
Sure, but you believe that this company's equity is going to...
It's only your model of like, oh, this is why you buy a thing, a little bit rich, right?
No.
In reality, people believe in appreciation. Cash flows is part of that, potentially.
Okay, they believe...
they believe that certain things, so they think they'll be more valuable tomorrow than they are today, whether or not it comes out as cash flow.
And the reason... Yeah, let's not conflate cash flow with dividends for a second. I think that's what you're getting hung up on is this idea of distributions versus cash.
Sure.
So let's just...
Companies also lose money every year that have negative cash flow that are, maybe they're worth less today than they were 6 months ago, but...
Sure, but like the reason people own pieces of anything, real estate or company...
Them more in the future, they'll be worth more than they're worth today.
And the reason they think they're going to be worth more than they're worth today is because eventually they make money. And eventually that money-making machine can pay me as a shareholder. That is
in some form. Yes, I agree.
Right. That is literally equities by definition. Okay.
Amen.
So we now have these two things and you say, for some reason, we want people to be able to freely trade ownership.
Well, what do you mean for some reason? It's for a very specific reason, which is that liquid things are more valuable than illiquid things. That's just how it is. And there's a very good reason for that, right? Which is like, if tomorrow I need some money, I have a liquid thing.
Sam, I would tell you that the private markets of technology companies in the last 1 year would tell you that is not actually true when you have highly illiquid startups trading.
At a weird anomaly, we can get into why there's nothing to do with this. I think it'd be, Zach, are you...
All right.
Is liquidity valuable? Is liquidity valuable?
Sometimes yes, sometimes no.
Why is liquidity ever not valuable? When is the option to sell something ever not a bad thing?
Why don't startup founders want people trading their stock all the time?
You know, the reality is this is changing a lot right now. The answer is they don't want it because they basically want to be able to sell more stock to people like VCs to raise money for the company rather than just people picking up secondary shares is one reason. Two is when you have a tightly controlled cap table, it's nice to not have 1,000 weird incentives, not for the reason of, by the way, a legal reason, which is if you end up with too many shareholders, you have to go public. So the fact that private companies don't want freely traded things in like the tech world or whatever, completely fucking irrelevant. The point is liquidity is valuable. If you drop transaction costs, make it easier to trade a token, which is a bearer token. By the way, this is how...
I'm sorry, but we're still not doing this because I just want to, because there's so many statements you're making.
Do you ever get called by a company?
No, I know what a bearer bond is. I'm not a moron. I understand what a bearer thing is. There's a reason we got rid of them because people were killing each other to own them.
Why did we get rid of them? Why do you think we got rid of them?
It's absolutely insane that somebody can murder me and take my bearer bond and have my money. That's why we got rid of them. That's a crazy thing.
No, there's two reasons bearer tokens went away, right? And I think they're important to understand because we're bringing them back, right? In a sense, right? One reason absolutely is from a security standpoint, right? By the way, banks talk about regulatory capture. Are bearer certificates good for banks? No, banks don't want bearer certificates. Banks want to custody this shit for you so they can make profit off of it, right? So there's a whole regulatory capture story to why they went away. And two is you don't want to lose the fucking certificates. I would argue this is a place where crypto has real leverage, right? Which is, yes, some idiot's going to lose their private key, right? And that's bad. And like systems should evolve to like help them with that or whatever. And you can't save people from their
help them with that or whatever. When they lose their token to the equity, we'll help them with that or whatever.
There's plenty of people. Let's be really clear. There are plenty of companies that work on the custody problem for people who are unable or unwilling to self-custody, right? The option is
everybody, by the way. No one's going to self-custody their interest. I just want to finish the story. Sorry, Sam.
I self-custody a hell of a lot. I mean,
you're crazy, man. Like that's crazy to do that.
What? Really?
Yes, because if you get hacked or corrupted in any way and you're like...
Yeah, sure. Then it's, I think, on the spectrum of risks. I'll give you an example. I both self-custody Bitcoin and I had Bitcoin with third parties. You know what I've been doing the last day? I've been calling third parties and saying, are you solvent? Are you going to sweep my Bitcoin? Where are we on this? Right.
Well, let's not get into the...
No, this is important.
That's self-custody of it. That's self-custody of it. Sam, that's self-custody of a digital asset, which is a totally different thing than self-custody of a physical asset, which is not going to do.
It's the same fucking thing. I don't know. Why do you think that's a different thing? Explain to me why having a digital bearer bond, right? Effectively, we'll use that example, or a digital self-custody is any different than me holding this watch.
Okay. Because we got rid of physical bearer bonds in the world, right?
For regulatory capture reasons and security.
No. We got rid of physical bearer bonds because it's the single dumbest way to hold money. Because having physical possession of something is showing that that's proof.
You know what? You know why having physical custody is bad? It does historically make it harder to trade. If I have a physical stock certificate, I'm like, hey, I want to sell that to Logan, and Logan's halfway across. Well, it's really fucking hard to organize that sale.
You know what else is like really annoying? You know what else, Sam, is really annoying when you have a physical thing? Sam, what about a hurricane or a fire or a thief or someone robbing you? Or I don't know, the electrical grid goes down and you can't open your safe. That's
the reason that self-custody was a bad idea was, yes, there's some security issues, right?
Some security issues?
You can't have a market, but that's the beauty again of crypto, which I think you have to understand, which is digital.
You've recreated bearer bonds is what you're trying to sell me?
Hugely valuable. That's hugely valuable in a world where, by the way, those bearer bonds have a new property.
You have literally turned back time to 1840, where I had to physically own the thing and show possession of it to get my money back. We got rid of this stuff in the last 150 years.
Well, we got rid of it for pre-technological reasons. Now that I can
got rid of it.
No. Zach, the fact that I can now self-custody something, right? Own it, hold it. And when Logan, by the way, you have your
lose it, have it stolen, have it scammed.
You have your LLC units. No one knows who the fuck owns them. I want to put a bid in. I have no idea to talk to. I have no idea how to organize a trade. Or beautiful new system. I can self-custody this shit. They're on the chain. They're matched one.
Sorry, because I wanted to get through this.
In a second. As long as you believe that liquidity is valuable, which maybe you don't, it sounds like, then that is effectively more better system.
I think liquidity has value in the right places at the right times for the right things with the right protections.
Explain to me one scenario where liquidity, where you take two assets, say, I'd rather have the illiquid one versus the exact same liquid one. Explain, as an investor, give me one example where that would ever be true.
Well, for me to have this liquidity, do I have to own a coin that can be stolen from me and then I lose possession of it?
That's a specific question you're not answering. Which is,
well, I'm not answering it because in isolation, it makes no sense. Because I have their trades, man.
The liquid version, Zach. When would you ever, as an investor, choose the illiquid version over the exact copy that was liquid?
Because I'll give you, okay, besides the fact that this is do you, this thing that is.
Because you don't have it.
I mean, I do have an answer, and I'll just give me 1 second. Okay. First of all, I would prefer to have liquidity on most things as long as
On everything.
as long as that liquidity doesn't put the underlying asset at risk.
Yeah.
Okay.
Which I would argue that our structure has no risk. This creates no risk to the underlying structure for that.
Okay. So let's talk about this in its real form. So you've created bearer tokens, which means we have like the 1840s version of owning something. And now
we did superpowers of the modern technological age, which fixes a lot of problems.
Totally. So here's what happens, right? In this bearer token thing, you've got, I don't know, let's call it like 100 owners of this bearer token.
Sure.
5 of them get hacked.
Sure.
Not 100. 5 of them get hacked, right? Now they lose their money, right? Because they can't like physically show that they own this thing. And now that liquidity that I really wanted, because it was cool and I could trade it, all of a sudden everyone's going, well, wait a minute. I can get hacked and lose all my money.
This is the argument you're going to rely upon. I'm just pushing you. Your argument that you're going to rely on crypto not being valuable and bearer token not being valuable is because people might get hacked. That's like your summation.
No, I'm going to go through like 40 reasons why it's not valuable, but I'm going to start with the first one, which is that if somebody steals it and I have no recourse, I've now traded liquidity for massive risk that all of my money is going to be stolen.
Well,
and this is not, sorry, so just to be clear, sorry, it's not just the 5 people whose money got stolen.
Okay.
Right? Because now everybody who's potentially going to invest in this, including the other holders, go, wait a minute. In order for me to get liquidity on this thing that I want to own, I've now got this like risk over here that actually happened to 5 people.
Being hacked. That's the risk you're worried about.
That's one risk.
I'm just trying to explain. I'm trying to go through examples. I don't understand it.
The first risk that we can talk about here is the fact that like if I have to bear this, hence your bearer token.
You don't have to. If you want, you can custody with someone. You can custody with 1,000 people. You can have insurance on it. You can do all the traditional stuff you already do. And you can pay for it, by the way. You're just saying it's an option to self-custody it.
Sure, I can give it to a third party who now I have to go through all the transfer.
Exactly what you do with your equities and exactly what you do in your cash and everything else in your life.
Totally, yeah.
You're not forced to self-custody things. It's an option and a valuable option.
I understand it. And my point is what we're going to end up with at the end of this isn't exactly the same centralized system we have today.
No, I disagree with that completely.
You just said you're going to centralize the custody. You literally just said you're going to centralize the custody.
That people have. And by the way, I'm not even focused on this issue because again, we go back to the point. The point is long tail liquidity for the majority of human assets, which does not exist now because they're impossible to trade.
I want to go back to this because I have it in my head and I keep getting distracted with some of these other weird detours. Okay. So then we go back to this retail thing. Look, and we can probably cut to this maybe.
This is the problem. You guys didn't control the edit, but keep going.
Oh, and we're not gonna screw you over or anything like that. It's just more we went on detours and it's like a little.
Wait till Liron gets his hands on.
I promise we'll do that. No. So we're gonna go back to the LLCs. We have these 2 LLCs.
Sure.
One has a bearer token. One does not have a bearer
token. Easy to query, easy to bid against, easy to transact, and one has nothing.
Got that. So if I want to buy into one of these LLCs, right? Because the reason I want to buy into an LLC that owns some underlying asset is because I think it's interesting to own that underlying asset, right?
Well, you think it'll be worth more in the future? The LLC will be worth more in the future than it is today. Yeah.
Okay. So how do I find out about that underlying asset?
Okay, so this goes back to, this is your other argument. Your other argument, just to decompose, one is like, oh my God, self-custody is scary. Your second argument is there's not enough due diligence, right? I can't look at some financials.
No, I'm not saying there's not enough. I'm just asking how I do it. How do I?
What you want. The way I do it as a private market investor, you call people who are involved. You look at what you can. You can ask the DAO for statements or some sort of information. You can go look at the property. There's absolutely no difference, right, between either of these routes, right?
Yeah, I agree. Same thing, right? Like I agree with you actually. Like so. Yeah. First, I have to find out about it.
Sure, which is again going to be a lot easier in a digital space than not, but not massively the point.
Well, also, I mean, like this LLC can also create a website too, and like market it. So, like being on a chain doesn't actually make discoverability any better.
No markets and no liquidity, and no one. I mean, this is why for a whole bunch of reasons. We keep going.
Well, the reason most groups don't do this is because they don't want random shareholders, but that's a different story. Like so I put some information I'm the company now. I put some information about my LLC on the web.
Or they might not, and the third party might do it. But sure, there's
Sure.
some information that makes you want to invest.
Right. Which is like the first step to having someone get interested is I have to like share a bunch of intel about the business, like literally what it does, what it owns, how much money, whatever.
Who knows?
Something about this business. So there's a discoverability. I'm just like going through like, how do we actually create liquidity here?
Discoverability. Not a problem. Crypto really dramatically. I think I can come up with arguments. I don't think it really matters. I agree with you on that.
Somehow I've got to discover it. Okay.
Sure.
Then I want to know.
I want to transact. That's where crypto has leverage.
Well, I'm not there yet. So like now I want to understand, okay, these are the financials that you've sent me or I've looked at or whatever.
The financial thing, it's such a red herring. You do some research, you want to buy a thing. Okay. Can we agree with that?
I do some homework. I'd like to buy it. Okay.
Great.
And now I call which by the way, just to be very clear, is the exact same thing all the way up and down the stack.
100% agree. There's no difference. I mean, I'll make arguments with some of that, but for the sake of this debate, no difference in discoverability and diligence.
Right. So we're like 98% of the way to the finish line. We found out about this thing.
That's the thing. That's the thing. You're not 98% of the way to the finish line.
I'm just want to
you want to invest in like you're there.
No, I'm going to walk you through how I do it in the real world, and then we can talk about how we do it. And because I've done this, so I've found something that's interesting because someone told me about it, or they had a website or whatever.
By the way, I wouldn't have access to their full financials.
No, but I got access to some information, right? Like about it.
Some information. Nothing to do with audited financials that we were starting with. Nothing. None of that stuff has been scoped.
That's solved by the fact that there's an LLC, which I think is fair. So there's an LLC that like underlying has the governance structure here. I do my homework. I talk to the CEO. This is something that's actually kind of interesting.
Sure.
Okay. I'm like a normal, rational investor who wants to understand what I'm buying. And then I say, towards the end, by the way, of the timeline here, because I've done most of the work.
Maybe towards the end. Keep going.
I would like to buy this thing. Or really, I want to buy a share of this thing. Okay. In a non-crypto world, let's just describe what happens. My attorney requests an equity purchase agreement from the company.
Well, maybe there aren't shares. Maybe this company doesn't want to sell you shares. Maybe you need to buy from you're buying it from some other person. Maybe the CEO says, you know what? We don't need more capital. We're not going to actually take money into this LLC.
But at the end of the day, we're still in a situation where there is a seller of a thing I want to buy. How I got to that thing is the exact same. We've already agreed.
You're trying to simplify it by saying you're buying it from the company. When actually,
I don't care who I'm buying it from.
Markets, you're buying it from a holder.
Okay, right? Fine. I'm buying it from a holder. I'm happy. Okay.
You don't know who the holders are.
Well, that's because the holders haven't marketed it because they're not allowed to. But I'm just saying at the end of the day.
Actually, you're allowed to say you're a holder of something.
Well,
there's no rule that says you can't say you're a holder of a thing.
Yeah, no, I mean, you can see what I own. The point is, at the end of the day, I'm buying something from a person that I found. I found this human.
No, you're taking a market and saying, I'd like to buy a thing. This is what I'm going to offer. Who's willing to sell to me? Big difference.
You just created what is like essentially a website that matches buyers and sellers. There's nothing to do with crypto.
Yeah, but
to be very clear.
That's exactly my point. This is my point from the beginning. Of the Fed server. Could you have some magical meta website, right, on top of some magical meta server that had all the LLC shares and the owners and their email addresses, so that whenever you wanted to make a buy, you could hit a button and say, "I did this on these shares." In theory, sure, never going to happen.
Okay,
so still allowed to do this from the ground up, which is super cool.
No, it doesn't. Because the person still has to take their shares and turn them into coins and put them on the website.
No.
Yes, it does. How are you going to buy my startup shares that I haven't listed?
Let me be really clear. If your point is that there's a lot of LLCs in the world and this is a new structure and there has to be a translation, 100% agree.
No, that's not my point. My point is at the end of the day,
if I have an agreement, right, which is a legally binding normal world agreement, which gives you bearer tokens and not a new concept, bearer shares, it is in a new technological platform, which has some really fucking cool properties, which drops transaction fees and increases liquidity. What's your problem? It actually creates wealth for everyone.
I mean, it doesn't do either of those things, but at the end of the day,
it does. Liquidity, unless we're going to go back to this whole thing where you're going to make an argument that liquidity isn't valuable. Are we back there?
No, my point is that I can do the exact same thing once I pick. Okay.
Wait, at the same transaction cost? No way.
Okay,
You can do exactly the same thing.
I go on
higher transaction
I go on
cost, which makes the
Carta.
deal irrational for more.
It's not higher transaction cost. The what I was going to get to is the equity transfer agreements like 2000.
I'm literally selling private market shares of a company as we speak. I can tell you the transaction costs are astronomical.
But then you're getting screwed by the attorneys because
you got to find the right buyers and sellers. It's a fucking mess. So like the idea that you would argue that creating more liquidity with the bearer tokens, which can be custodied if you're scared about someone hitting you with a wrench, right? And like that doesn't create wealth and prosperity and is absurd. Now, you can make the argument that you don't need crypto for that you could do with Fed server. That can be a different debate. It's never going to happen, as you well know. Right?
Well, you can do it. You don't need Fed server. You can do.
What do you need? You either need Fed server or you need Goldman Sachs to stand up a private LLC market exchange, which they could do. The problem with that, right, is one,
well, you could literally go to Carta, which Carta has Carta X.
Carta's trying to do this. Have you ever tried to transact that way? I mean, the reality is that's kind of the point, is that it's way too fragmented. It's uninteroperable. You in theory,
no. The reason, I'm sorry, that's just not true.
The princely right to some bank or Carta or someone to say, we're going to sit on this exchange and extract transaction fees on it. Or you can do it using really fucking cool technology in an open way.
The technology is not the technology is not the problem. The reason Carta is hard to transact on is because companies don't want to list their shares on it.
Well, this is why Carta is not the right model, because Carta charges an absolute fortune to companies. A lot of people are leaving Carta for this reason, with respect and love for them. And they're designed for technology companies, right?
They're designed for startups, yeah.
The problem with their shares transacted are very, very simple. They don't want to have to list, right, and go public with too many shareholders. They generally want to be tightly held, right, for a whole bunch of reasons we can get into that are separate, right? And when they want to go out, to your earlier point, they want to sell the shares because they need to raise capital for their operations. They don't want a bunch of secondary shares floating around.
My point is
that's very different than most of actually the asset base of the world.
I guess the point I've made poorly over an hour is that in order for you to acquire shares in something, to legally own the right to a piece of an LLC, you need to sign a document that says that you own those shares. You need a legally binding piece of paper that says you own those shares.
And my argument to you, just to be clear, is yes and no, right? My argument to you is yes, and that, when we start SDAOs, everyone starts out with those normal agreements, all exactly as you described, right? Part of the agreements is the existence of bearer tokens, which represent that ownership. Does that need to be legally challenged in court someday by someone or repeatedly to establish it as case law and relied upon? Sure, that's actually how innovation happens, right? You need to actually create test cases and go through it. If you're arguing you don't think that that'll happen or that will be invalidated, I think that's just insane, right? We'll find out, won't we?
Yeah, I think the idea that...
But the thing I'd like to acknowledge, maybe if I can get to acknowledge it, is that a world, let's just start with principles. Liquidity, good. Do we agree with that?
No, I don't. Really? I don't. It's not always true.
You're a smart guy. You're a smart guy. How can you possibly not believe that if you had two things, that creating more liquidity for more things is bad? That's literally because more valuable.
Because this idea that liquidity good in isolation is a reality is not true. There are trade-offs.
The hundreds of years of economics say you're completely...
Dude, you're trying to... Sorry, hold on. You're about to argue hundreds of years of economics and you're trying to take us back to 1840 where you need custody of the physical thing.
Thinking back to improved 1840. They had certain things right in 1840, right? As I'd say Bitcoin is a really interesting... There's a whole era of free banking in history, which had a lot of problems, right? But some of the benefits of it, you get to come back with Bitcoin. And I think that's awesome.
Well, the reason free banking fell apart is because everybody lost their money all the time. The reason...
But again, that's because it was really hard to know about the credit worthiness of the bank that was issuing notes.
Because they weren't banks. They were made up banks.
Literally were banks that were issuing notes. That's how that era worked.
Damn. Can you answer one specific question of if there's a Carta that isn't charging astronomical, let's say Carta exactly takes the exact same thing we're talking about and does it for your DAO, right?
For free.
Lowers their fees. Yeah.
Their fees are zero and they're always going to be zero and they're guaranteed to be zero.
How are you going to get a company, Sam, it can't be free because you need a company to do the work.
They can charge a penny per transaction. The point is that's not how regular credit capture works. whoever owns Fed server of the liquidity of everything that's not listed in the NYSE, I promise you.
This has nothing to do with Fed server. The point is,
it is, because I think the argument is that is why you need a decentralized protocol for doing this stuff and not centralized Fed server or centralized Carta.
You don't need centralized, decentralized anything.
Platforms. I can promise you how rent works. I've seen it do banking. Like,
you don't
that's how it works.
need any of these things to buy. No, if I want to go buy a share,
you're right. We can spend thousands of dollars on lawyers. I mean, I literally, here's the funny thing. I sold some, here's a funny specific example. I sold some shares of Ripple, which I was a seed investor in, the company, right? The other day. You know what the fee was? Literally for just signing the paperwork to move those shares? Take a guess.
I have no idea.
It's one signature that was on a standard form. How much do you think they charge just for the signature?
$100? I have no idea.
$3,000. $3,000. You know why? Because they can be, right? Because because in the big picture, but that's a fucking high transaction fee, and that keeps a lot of transactions out of the game, right? So again, I just go back to the whole thing, like, look,
there is no way.
The big theme I would put in front of you, just to scope out for it. We can keep going, but I just scope out for a second because I got to put my kids to bed. Is like, look, the idea that crypto, right, enables some magical end-to-end use case that's perfect, that has no human intervention, no human institutions, and is like whatever. The only way that's even possibly you could think about that is some sort of self-contained crypto world we live in of 3D avatars. I think that stuff's all bullshit to very, very far off. What I would say is this. There's a bunch of problems that the internet screwed up and almost got there but didn't. One is long-tail liquidity. I can know about a lot more apps. I can Google a lot more things. I can't buy them. Two would be like identity, like when we were talking at Facebook. Again, identity is one of those problems where like, could you have a centralized identity server so we know who to trust and there's real reputation?
Let's leave the identity thing out. This is a whole separate
point. But I want to make this point because I think it's important, Zach, for you to hear and think about, which is like, you could poke holes all you want in like a specific layer and is it specifically better for this? That is not the point. The point is that crypto creates an open framework and ecosystem which allows effectively enhancing the internet, which there's a lot of things the internet missed, right? And I think it's extremely exciting and there's an extremely valuable future to it, but it largely is things which, of course you could in theory have a centralized server everyone trusts. It's just not going to happen. And it doesn't, and there's no chance that anyone will win an argument with you or is even rational that says, oh, there's some magical thing. Crypto in some ways delivers no reliance on any human institutions. That's crap, right? That doesn't mean it's not valuable.
But you said, because I want to talk about the liquidity thing, because I still think this idea of like,
I believe you're saying liquidity isn't fundamentally valuable.
Because it's not, you don't get liquidity without some trade-off, right? It's not liquidity in isolation. Sure.
Actually in some cases is.
No, but it's not, because there's clearly trade-offs. And I just want to talk about the trade-offs.
Companies want to go public. If you don't think liquidity is valuable, why do you think companies go public?
No, I agree that at a certain point in time,
liquidity is valuable. Because you're massively better off with a liquid currency, right, that you can use for all sorts of things, as well as that makes your people richer.
Sam, if that were true in isolation, if it were just better to have liquidity, then every company in the world would be trying to go public all the time. There's a reason.
A bunch of other problems. Like if the answer was the public markets worked the way they worked way back in the day, I agree with you. Problem is that's not how they work.
Sam, the reason it's hard to go public in many cases is because people were going public with scams and stealing people's money. Just fact, right? Like that is why yes, it is. That's why we have rules. It is.
You think Sarbanes-Oxley is 100% because of scams?
It's not just Sarbanes-Oxley. There's layers of.
This is the burden of being public. This is the cost of liquidity. The cost of liquidity is shit like Sarbanes-Oxley. There's a reason there are fewer public companies than ever before.
But this is my point. As you said, I'll use your words. There is a cost to liquidity. Now, because there's always a cost to liquidity.
Sometimes directly your words, not my words.
You just said it like 2 seconds ago.
Liquidity as a public company is what I said. I didn't say there's a cost of liquidity. I'm trying to fix that fact.
Okay.
Right? I'm trying to fix the fact that there shouldn't be such a high cost of liquidity.
The reason, let's just start with the reasons, right? Like the reason there is costs associated with being public is because people were going public with vehicles that didn't exist and fake income and fake companies. They were screwing people over. So let's just leave that aside for a second.
Well, again, I don't fully take that, but I agree that happened. And again, that's why, again, like what I look at when the LLC investing, it's just for accredited investors. It's people say like, I don't want the protections. I'd rather have liquidity. I'd rather have access to a whole other set of assets, and I'm illegally allowed to legally exempt myself from this protection.
This is my point of like liquidity and isolation is not exactly always good because there are trade-offs.
Is good. Okay. No. Liquidity. This is the thing. I think you're saying it backwards. Liquidity and isolation is good. Liquidity in the context of how you generate liquidity in 2022 America has a lot of trade-offs to it.
Yeah, I exactly. No, I agree with that. My point is like
what you're saying. You're actually saying the exact opposite of what you're saying. Liquidity in isolation is good.
But it's a fake thing. It's like saying unicorns are great. Like,
no, I mean, we're trying to start from philosophical things. Do you agree that liquidity in isolation is good?
Yes, but that's not real. That's not a real thing.
Great. So like that's actually a big breakthrough because we started
because there's trade-offs.
Like because there's
trade-offs. There's trade-offs. There is a cost.
Yes, there are trade-offs. But those trade-offs don't have to be so dramatic. Like it's just the point. This is the opportunity, dude. The opportunity is that right now the trade-offs between liquidity, right, and all the shit that you have to do to have liquidity are insane. And we're trying to fix those.
Here's the two trade-offs. I just want to like take us back for a second, okay? Because we said we think liquidity is better. There are trade-offs.
Which is great. I'm glad we had that breakthrough.
There are trade-offs in liquidity. There's trade-offs. There are trade-offs in being a public market liquid company. Now let's talk about
it has to be public market. That's right now the trade you have to make.
Cool. Now we talk about private
liquidity. Is that right?
Here's the two private market, and I'm sure there's more. Here's the two private market crypto liquidity trades you've decided that we need. Because we're asking for liquidity to be able to trade these coins around, right? The first trade.
We're saying I want liquidity in the vast majority of human unlisted assets. Crypto has an incredible framework coupling messaging, custody, and a lot of other key principles that with bearer tokens make that super doable. That's awesome.
Cool. Let's just talk about the cost.
Is that awesome?
No, because I just want to talk about the cost of it.
Why is that not awesome?
If you'd let me tell you why it's not awesome, I'll take 2 seconds. And I'm sure there's more, but here's two. One, which we already talked about. If anybody
is the wrench attack. Is your scary wrench attack? Is that the reason?
It's not a wrench attack, but like if anybody loses their bearer token in any way, shape or form, their money is gone.
Yeah, just as if you lose $100 on the street, it's gone. Sure.
Correct. Right. Which is why we don't like use cash for private transactions.
If you're worried about that, you put it in a bank. If you're not worried about it, you keep it in your wallet and you might lose it. That's freedom, baby.
Okay, cool. So one cost, Sam, one.
That's not a cost. That's just, keep going.
Okay.
Because it's a choice. You can choose to pay for more custody, right? Which lowers your chance. You trust a third party, lowers your chance of losing your $100 bill, right? But there's a cost. You can choose to bear that cost if you want.
Right.
Sure.
So one cost of crypto liquidity of long tail assets.
Is that you have to pay a bank the custody for you if you're scared of things? Yes, but that's not an incremental cost.
Or if you lose your password, you lose your admin, you lose your whatever.
But that's not an incremental cost. Like that's exactly the system we use in this. So what you're saying is crypto has the option of being better, and in the absolute worst case, is exactly as bad on custody as we exist in today.
So we've stuck that we've said.
Is that's the it's
just
much better or equal. Not worse, equal, better, or equal, and then you get to choose. How is choice not a problem?
I guess what I'm saying is like because the risk of owning and holding the bearer token is losing it and losing my money.
You can choose to take that risk or not.
Right. So now I have to own it with a custody. So I've already put this third party in, which creates.
You don't have to. You can choose to if that is a concern you're worried about.
I'm a normal human being. I don't want to hold $100,000 under my bed sheets, man. Like that is a. Okay, that's the first one.
And
that's the first
for the transaction. I bet there's a price at which you would choose that.
And I shouldn't always use. I shouldn't use the security one because it's always it's too weird. The second fee,
it's very 2012 to use a $3 wrench attack argument against crypto. So keep going.
It's really more like 2022, given how much money was stolen this year.
I'm not. Again, it's de minimis in the grand scheme. Keep going.
It's only like a few $1 billion.
Yeah, exactly. That trust
and it happens like increasing frequency all the time. Because it can't be reversed, and so it's really incentivized to hack stuff.
Keep going. This is a weak argument. Keep going. You got better ones.
That's losing billions of dollars sounds great.
Give me a better argument.
Okay, now you said, hey, here's the other price of liquidity. I'm sure there's like 5 others if we actually dug into the detail. Is
the price of liquidity? To be clear, is that I can choose to pay no custody fees, or if I want, I can have a competitive custody solution. That you think is as a cost of liquidity?
No, I think there's a cost to liquidity of the fact that
doesn't make any sense.
That there is a bear. Just hold on for a second. There's a cost to liquidity of having to take physical custody of an asset.
You don't have to. You have the option to.
I understand, man. You said the same thing 17 times.
I just you can't say something that you can choose is a hard cost. It's a thing you can choose to do.
Okay,
that's not a cost of
99% of normal investors.
It's not a cost of liquidity. It's you can choose to layer, just as I can buy insurance.
Okay, all right.
Insurance is not a cost. Insurance is not a cost of
Okay, let me then I'll say it in a.
So there's no cost. There's no cost to custody to liquidity. Let's keep going.
So now we'll go to users. Okay, I'm the user that. That wants to self-custody my asset.
Sure, if you want.
Okay. Just on that person for 1 second.
No cost of liquidity. Keep going.
Well, the cost is that I take a risk that I lose it.
Okay.
Correct?
We can argue. You could choose that cost is price as the price of insurance and how you feel about it. So it's a process you could choose to incur.
Right. I choose, there's the risk that I take for self-custody of some digital token that promises me future
ID. Which you price and value as you see that risk personally. Sure.
I think most people would think that's pretty high. Second.
I don't think that's accurate at all, but keep going.
Nope.
The most people argument is like pretty weak. So keep going.
Well, I guess if we described a scenario where you owned $100,000 and if you lost your private keys, you lose your $100,000, the number of people who would choose to do this, because we're talking about accredited investors, by the way, to your original point. This is not
no insurance.
Right.
It's not. No, that's completely false. I mean, I
don't think it's none. I don't think anything is binary. I think it's a very small percentage of people who would be like, I'll stick it under my bed and I'm cool with that.
Again, so the price is marginal competitive insurance industry based on people's preferences of how they want to custody.
Right.
Let's move on because I think it's a really weak point. Keep going.
No, I know you think it's a weak point, but I think for a normal investor, they're going, okay.
It's a cost. It's a cost it's a cost. I don't think it's a cost of liquidity. So keep going.
Well, you describe the benefit as being liquidity. So I'm saying the cost of self-custody is the risk of losing it.
Okay. So or a big
just let me just work this through for 1 second. There is
we should move on because I don't think it's a strong argument. What's your number two?
Well, it's impossible to even finish it because you keep repeating this whole liquidity is good thing like a religious guy.
It is. And even you said it was good in a vacuum.
In a vacuum, which is not where we live in normal human times. So going back to this, there is a risk to self-custody of this thing if I lose it. And and I can pay for insurance if I so choose, which is a cost.
Yeah.
Okay. Now we've got this second issue, which is like, all right, now I'm going to introduce this third-party custody who also bears a bunch of risk in case they lose it.
Get carte blanche, supposing I can buy insurance in lots of ways. I can say, look, I'm going to self-custody, but I'm going to pay some insurance broker in case I lose my key. Again, I think but keep going.
No,
the argument's going to be, it's all going to re-centralize because you're going to have custodians and all of it. Is that going to be your argument?
No, I'm just going to go through the trade-offs and there's more. Although by the time I finish going through the trade-offs, I'm going to be 85 years old and hanging myself from the rooftop here. In the second one, right, there is now, yes, in this specific use case, there is a new middleman. It could be a bank. It could be a Coinbase. It could be whatever, who custodies my 1980s bearer bond or whatever coin, right? So there's a fee that they'll charge me to custody it. There's a risk.
Which will be a competitive market because it's an open protocol, which means I can easily move it if I don't like how they're charging, correct?
Sure. Yes, it'll be a competitive market to custody.
Competition to zero among custody solutions for custodying from me, because since it's a protocol and not a centrally hosted server, I can just move it if I see a better deal. Correct?
Well, I'm not sure when I'm holding custody of something worth hundreds of thousands of dollars that I want the cheapest option. I probably want the safest option.
Well, whatever it is. The basic point is that it's a competitive market that will be priced to near zero.
Right. And if anything happens, we all know we always lose everything because it can't be reversed. Now, then, which we've seen happen multiple times. Now we say, because we're talking about reducing transaction costs for liquidity purposes, right? So now we say, when I buy this token, second issue, I don't have to sign anything. right? I can just buy the token.
Well, you're signing it digitally, I'd say. You're signing a transaction in a digital space. You're not signing with your DocuSign, which by the way is also a digital space. We can argue about that versus a wet signature versus a notary.
Whatever.
But like, yes, you're signing a digital thing rather than a traditional paper contract
Right.
with or without a note.
I'm not signing.
Sure.
I'm not signing a contract. Okay, and
At
then
that
we're
time.
at that time, right? And then we're saying that if I don't get paid, or
You
if
do so.
I sue somebody, and then we're saying in order for me to have certainty that my lawsuit will hold water in a U.S. court system, because I haven't
Yep.
signed anything, we have to go.
You digitally sign something, which I think if we keep going, just
Well, I didn't
you know,
sign. I didn't sign what a normal document looks like, which is a equity
keep going,
purchase
keep going.
agreement,
You
or
you sign something digitally, which we could argue is actually way more secure, but keep going.
it's not about security. I'm just talking about what document I
Yeah, yeah.
have. Okay, and now what you're saying
It's
is
a bearer token, just as, again, we can trade these things and there's no purchase agreement because most human assets don't have purchase agreements.
right, but I'm not. It's not the. I'm not buying a
We are
watch
usually the most human assets don't have purchase agreements. So again,
because those purchases are final.
actually, this is finality, a great crypto principle. That's exactly the point.
Sam, the difference between a final purchase of buying a watch is that I have physical possession of the watch. The difference between buying
and you have digital. That's again, you're
no, you're wrong. But this is. I'm sorry.
It's irreversible. That's been your whole argument about why it's so scary. It's
Yes.
exactly like Buck.
You know what part of it is irreversible? The digital representation of it is irreversible.
It's just as this. If I sold you a bearer certificate in 1800, right? It's the exact same thing. It's exactly the same thing.
Yeah, I agree
Right?
with you. That's part of
And
why
it's
it's
not
crazy.
reversible in exactly the same way. Because
I agree that it is the same as in the 1800s when I sold you a bearer bond. And
the idea that because it was old, we have new technology and new tools. We don't find ideas in history and re-update them with new technology. That's awesome. And so if we're in a disagreement, if your view is because it was old and we stopped doing it, it must have been bad and we should never look at that as an example, I think it's pretty weak, but fine. I mean,
we can agree to disagree about the utility of physical bearer possession.
And we're not actually disagreeing. What I think you're missing.
You think it's
I'm
good? I think
saying
it's bad.
there were cool properties of that system, which, when updated with modern internet technology, communication platforms, et cetera, gives them all the benefits, right, of tradability, things like that those things lacked, which is why they went away. But actually some of the benefits those things had back in the day. And that's sweet. That's mixing what was awesome in history with new things, which make them viable again. It's great. So like, and then go back, it's like,
fine. I will give you that if you think bearer bonds are cool, this system is going to be amazing for you.
Updated bearer bonds.
If
Modern technology.
We can go with the branding there. But now, the thing that I've been trying to get this for 45 minutes, but it's impossible. You said that it's unsettled case law.
Yep.
Okay. I just want to talk about that for 1 second. Okay. I bought this digital representation. I know I own it because I know it's a bearer token in the world. Now, I don't have a signed legal agreement because, just mute yourself for like 2 seconds. Okay. Like, I don't have a legal agreement because we said
it's a bearer token.
It's a bearer token and we don't want transactions.
Historical precedent with a lot of historical precedent, but keep going. Because we just talked about how they're so old from the 1800s. So keep going.
Okay. I don't want to go down this path of like, are we saying bearer bond law applies to crypto bearer token law?
I'm not a lawyer, but when this does come to court, I think that'll probably come into play.
Okay. Maybe that might be true. But
I'm just saying it's not without precedent. I think this idea there's not is wrong.
Okay. I want to pitch you your bull case, right? Which is, I now have this like bearer token thing, right? Which I can trade freely because I can prove that I own it. And we're not going to talk about the losing it thing and the custody thing and the insurance fees and all the other stuff that comes along with that kind of risk.
Kind of minor bullshit issues. Yep.
Right. Just losing your money, which is minor. And then, okay, you don't pay me because LLCs are private companies and they don't have all the
And
rules.
everyone sues each other.
Everyone sues each other all the time. And by the way, private LLCs, especially, just pause for a second, especially long tail assets, right? These are long tail assets run by non-big companies that have reputations to uphold. It's usually like individuals, could be a lawyer, could be a doctor, could be a person you met on the street, right? So there's inherent risk in this, which is part of why you have LLC protections in the first place. If I want to sue this, because remember, I don't want to sign this legal document because, $3,000 legal bill. So I don't want to pay that $3,000 legal bill. That is a scary $3,000 bill.
Transfer for the transfer, but keep going.
Right. You said I don't want to pay. There's $3,000.
Transfer fees, which then crushes the market, and the liquidity, which is the value. So keep going.
I understand. You said self-accredited or accredited investors and qualified purchasers are scared of $3,000 legal fees, which is a whole different.
No, it just means the market's much smaller and less liquid and less efficient, right? I mean, it's hard to argue.
Well, we've already
again.
Just wait.
Principle.
Just wait. We've already
less liquidity.
We've already limited it to qualified purchasers and accredited investors.
100%. Because I don't want to touch non-accredited investors. It's not worth it.
That I agree with, and I don't want to pay the legal fee, transaction cost.
Well, and I want efficient market of coding, and I want efficient transactions. Yeah.
Hurts liquidity.
Yep.
I don't want to pay this fee. But now, when I sue to get the money that you told me you owe me.
Sure. Which will eventually happen in some weird form. I agree.
Okay. We have now agreed that there is no legal setup in the current world because I don't, just wait. Just let me finish it. Okay. Because you've said, I don't want to pay this transaction fee. For a second, you said, I don't want to pay a transaction fee because what that transaction fee is paying for, what it is paying for is a legal document that I sign and the company signs. And just wait, Sam, just wait. Okay. The reason I normally sign a document that says I am purchasing this thing and the company is selling me this thing is so that I have a legal agreement.
Third party, but keep going.
Doesn't matter. Some LLC is signing it.
Yes. Keep going.
Okay.
Do you think that people who buy and sell things from each other with legal paper don't sue each other all the time?
No, I agree they sue each other, which is where I'm going with this. The reason I signed this document with the LLC and myself is so that I know that I can go and sue in the court.
You don't need the paper. You can sue in the course without it. Look, do you remember when we were starting?
Wait. Sam, I'm not done.
I want to talk about case law.
Sam. It's like talking to my 4-year-old. Like, Sam, listen.
It's mutual.
I am going to
talk to my 5-year-olds. It's the same thing. Listen, Zach, do you remember when we were starting companies in New York? I don't know if you had this experience, but do you remember people wouldn't let you do digital signatures? Do you remember that? Remember you had to actually send around wet paper with couriers because people would DocuSign? Absolutely not. Like, oh, that's not legally binding because that's a digital signature. It's not a physical wet signature. You remember that era?
Sam, we never talked about removing the
document altogether. I'm asking you a simple question. Do you remember that era?
Of course I remember the era.
Of course you do. So what is do you think does that mean that DocuSign didn't happen? Are you not happy that transactions are easier to do now because of DocuSign?
Sam, you're suggesting we remove the contract.
No, I'm not actually. I'm suggesting the contract is embedded in the bearer token, which is an old issue. I'm not a lawyer, so I can't speak to exactly how bearer bonds translate into the idea of a bearer asset, which denotes something, right? And the idea that is somehow completely invalid. Look, I agree that eventually the courts need to try lots of things and like complicated, et cetera, but
we've just described
with digital signatures. What's the big deal? It's the exact same fucking thing.
It's not the same thing because it's not actually a signed contract. And also because it doesn't involve like an actual contract. And then separately, we're going to,
again, can you at least give me that there was an era not too long ago where digital signatures, non-wet signatures were scary and not to be done because they weren't legally binding and case law got updated and people got comfortable with them.
But there's can
you at least give me that?
Yeah, of course, because
great.
Yes.
So then
yes.
Why is your argument, your big argument is that, because there's unsettled case law on this already, it can never happen or shouldn't be done?
No, I'm not suggesting that it can never happen or shouldn't be done. What I'm saying is we've now created a way of purchasing tokens so that I can get liquidity in this company because I want to save on some
which is incredibly valuable and creates prosperity. Yep. Keep going.
Creates theft and bear. Okay. Anyway, like, because I want to purchase a equity ownership in an LLC so that I can make money in the future.
I want to basically be able to invest in things that aren't listed on the NASDAQ. Yes.
Yeah. I want to buy into like an illiquid company that has some asset.
And the point is not illiquid anymore, which makes it way more valuable.
I want to work on I want to buy into a private company. Sorry, that has like
more valuable with liquidity.
Okay. I want to buy into a private company for future cash flow. I want to be
for appreciation, which might be cash flow, might be something else. We don't know what it is, just as is with any other private company today. But I agree that I like cash flow.
I would like to invest in a company that at some point in time.
Just stop. Can you say you want to invest in a company? Full stop. There's no qualification needed.
No, I mean, the qualifications are and the details are what matter in life. Like, what does the company do, and do I actually own it? And can I get money? But like, no, we're not. Sam, we're not back to it because like I have an inability to actually even get to the end of this. Hold on, just oh my god.
Take us home. Take us home. We got to get there, Zach.
In order. Woo. Okay. I want to save my $3,000 legal bill. I want right.
Okay. Transaction fees don't matter. Keep going.
I want to save money on the transaction costs, as you said, right? Because we want like
liquid market. Can we say more liquid market?
We want instant liquidity because those pesky legal documents that get in the way of the instant liquidity.
It's an effort. It's hard to find the right buyer and seller. We want to fix those problems.
Yes. So that pesky legal document that gets in the way of unlimited liquidity.
And finding the buyers and sellers and actually moving the assets in a trusted way and all that other stuff.
So the legal document doesn't get it.
Blow away the friction. Okay.
The legal document doesn't get in the way of finding buyers and sellers. That's a different problem.
I think this is, you're trying to focus in to make a point. I'm trying to make a point that there's a whole layer of transaction fees. The $3,000 is part of it. It's not the only part that crypto improves. Everything else is the same. I don't see the big deal.
And this is a classic crypto. No, it's a classic crypto argument of you never let the person get to the actual use case because once you do that, it's not so good. Hold on, just
so awesome. I've been very clear with the use cases. Zach, I'll let you have the last word because it's your show and the whole 9 yards, but I really would push you, and I'm happy to do this some other time in some other venue. We can do this over in writing, which I think is a lot clearer than doing it on our podcast in an argument. But like, I really have not heard from you a compelling argument. You've agreed with me that liquidity is valuable. You've agreed with me that I think that we're not going to get a Fed server to do it, or that if we ever did, rents would be extracted from it.
That's not what I said.
I think that protocols and custody fees, right? Things like protocols versus APIs allow for a more competitive market and custody fees to be lower. And I think, unless I'm missing something, I have not heard a compelling reason why accredited investors shouldn't have lower.
Just so you know, there is no custody fee for holding my LLC shares. There's no fee to do that.
There's absolutely is. Are you kidding? No. Lawyers you're paying.
No, you pay the lawyers for the transaction cost, but it's different than actually the
anyone implicitly that. Well, keep going. Okay. I certainly pay lawyers for custody fees.
No, you pay the lawyers.
Not on an AUM basis, but I pay lawyers and accountants a lot of money to quote unquote custody things.
No, you pay the lawyer for the transaction. There's a separate entity that does the custody. It's like a few $100 a year. You pay the accountants to do your taxes and make sure you don't go to jail. These are different things. Most people don't actually understand this in crypto. They all serve a different purpose. My point is we've gone through this whole thing to say, we're going to try and create liquidity and lower fees in long tail private assets for accredited investors. These are probably assets that have like tens or not hundreds of thousands of dollars in terms of enterprise value.
But make up the majority of the U.S. economy.
Yeah, like it's a real estate and it's a doctor's office.
To be clear, I want to be clear. The public equities market where there's liquidity is a small minority of the U.S. economy.
Yeah, I agree that private businesses...
So we're trying to unlock the liquidity of the majority of the economy.
Yes, I agree. We are trying to allow people to speculate on the ownership of their local bodega.
It's such a turn word, invest. Why can't you just say invest?
We'd like them to invest in their local bodega.
We would like the majority of people who are accredited investors, or at least majority of dollars, I should say, right, to have access to the larger part of the illiquid economy
Sam, okay, for 1 second, just please. Just please.
Well, I feel the same way, man. We're in the, I'm just as frustrated here. Like, I just don't understand why this is so difficult.
Primarily because I can't actually finish a thought without you going on a diatribe. That's why it's so difficult. It's nothing to do with the actual ideas. It's more of your personality and general approach.
It's clearly my demeanor.
No, that's right, actually. Okay.
Yep.
What we're saying is we would like accredited investors to be able to invest in private companies, which just like
more efficiently.
How you actually convince somebody to marry you and have kids is beyond me. Like,
wow,
did you just like
pure ad hominem, eh?
Yeah, like
pure ad hominem. We just like drop the pretense entirely.
I just like, it is impossible to finish a thought with you without having you interrupt for whatever belief system.
I'm trying to clarify the point.
You can't even not interrupt me commenting on you interrupting. You literally can't. I'm saying you interrupt me and then you interrupt the point that I'm making about you interrupting.
Listen, I'm actually really late to kid bedtime, so I'll let you finish your like statement and then we'll pick this up some other time.
Sam, whose fault is that? Whose fault is that?
I think this is great, guys. I thoroughly.
I apologize for the wife. Like I shouldn't have said that because I'm just so frustrated that I literally can't finish a sentence.
But when you put this out, please edit that part in because I think it's an important part of the story.
Fine.
Keep going.
I truly don't care. You probably
just own it. Just own that you're in pure ad hominem land.
Yeah, I don't know if anyone will get through it because you probably interrupted that statement too. Let's talk about. We would like qualified investors, which is a subset of the market. We already said this. We have to KYC them. We have to figure out who they are. We have to know everything. There's costs associated with that.
Sure. Yep.
It is complicated. I agree. We want them to be able to purchase private assets. We want them to be able to buy stock in LLCs. I just want to be clear for 1 second. They can do this today. It's not easy. It's not easy. There's transaction costs.
Not easy.
There's transaction costs.
Mm-hmm.
There's risks.
Liquidity.
There's risk.
Limits liquidity. Limits liquidity. Can you give me limits liquidity?
Yes, it limits liquidity. Sam, it limits liquidity.
Great.
You get
and value. You give me that because of the liquidity is value, they're less valuable.
No, it limits liquidity.
Wow. Okay.
It limits liquidity.
The liquidity is abstractly a good. We did establish that.
In isolation, without taking context and anything else, it limits liquidity. Okay. Maybe we can publish just this part because I only got interrupted 7 times instead of 7,000. We would like them to be able to more easily than they can today purchase access to private LLCs. And those LLCs represent some underlying business, real estate, dollar store, whatever.
And can we also acknowledge the majority of the U.S. economy?
Yeah. There's lots and lots of private businesses. Totally agree. Doctors' offices, restaurants.
It's like 80%, 70 to 80% of the underlying equity value in the United States is not in public companies.
I don't know the actual number, but I know it's a big number. I agree. Yeah. There's a large number. Now, today, current world, non-crypto world, regular human world, okay? There are no reasons besides friction. What you think is friction. What do you think is friction? For me to be able to purchase an interest in a private company. I can buy a piece of my bodega. I can buy a piece of some lawyer's office. I can do all of those things. Now, obviously I have to find it.
Yep.
The company or LLC has to share a bunch of information about.
That's your words, not mine, but we can all go with it. So keep going.
Okay. Normally, a regular investor would like to understand something about the thing they're going to.
Please move on. Because we've already talked about how different investors have different thresholds. And you agree that you don't need audited financials for every.
I'm not talking about. There's some information. There's some information.
I really have to go.
There's some information that I would like to know about this company. This has nothing to do with the blockchain. Sure. Nothing to do with the blockchain, right?
Agreed.
So I've got to find the company listed somewhere. They have to share some information.
Someone has to share. I have to have an opinion. I have to want to buy it. Can we just say I have to want to buy it?
No, because that's not how the world works, man.
This is so irrelevant to the conversation because I agree that blockchain doesn't change it. So I'm just asking you to acknowledge that they don't have to share shit. They just have to have an opinion. They want to buy something.
Sure.
It's just, you're not giving me anything.
Well, what I'm
doing to help here.
What I'm trying to get to is that there's friction in the whole process, that the blockchain piece of it touches the very last piece, and it introduces risk. And it introduces risk. And if you would let me get through this, I will actually make the point, which is I have to, first of all, be a qualified purchaser. I have to find this business, nothing but blockchain, credit investor. Sorry, you're right. It's a lower threshold. I need to find the business. There's friction in that. There's friction in that. I have to understand what the business is, learn about it.
Again, we're back to this. Please move on.
I have to talk to the company, ideally.
Again, you don't have to talk to me. Why are we back on this? I've asked you to move on. That is like not true. And we keep acknowledging the different investors, different thresholds, and then you bring it back to this as though it's like has to happen.
Well, generally speaking, Sam, people would like to know about the thing they're giving money to.
Keep going. I don't think you're getting
it's impossible, but like people would like to know about the thing that they want to invest in. They would like to do a little bit of homework on it. I'm just talking about all the frictions. I'm talking about all the frictions that exist
there's a lot
today. Okay.
Crypto solved one key part of the friction, not all.
At the end. At the end. I agree.
Again, it's not necessarily in the end. And when you solve one piece of friction, you actually can cut as a cascade to solve other frictions, but we don't have to argue about that right now.
Okay. I go through this whole process of homework. I make a decision. Here we are, where you want me to be, that I would like to purchase this thing. Okay. Now, even though I've just done like a whole bunch of work to get here, right? To figure out what this is and do all the homework, whatever. I now want to make a purchase. And so we're at the last stage of this transaction, which is the purchase itself.
Yeah, this is about the purchase itself. I give you that.
We're at the last point in a long process, the purchase itself. Then we say, that pesky legal document and
yourself. This is
just let me finish the sentence.
Let me finish, and then I want a chance to expand. Can we make a deal on that? I'll let you finish, but then you have to let me expand because I feel like you're taking pieces and framing them as it's just the legal document. It's not just the legal.
Sam,
so please fit. I give me an opportunity.
Let me tell you one thing.
You have edit control, so you can edit however you want later.
Zach most certainly does not have edit control. I assure you, I have edit control. And Zach, make the point. Sam, make the counterpoint. Zach, say one last thing. Let's go. I want to do a part 2. Hopefully, I don't know if you guys are going to want to be around each other after this, but I have thoroughly enjoyed this. I've already tweeted out images of you guys mad at each other. So this has been awesome for me. And I'm sure, this is amazing content. Can we bring it home?
Yeah, I would like to. And Sam,
please. I literally, he's been asleep for 15 minutes.
We're 2 hours in and we're one example in. I don't know how this is possible.
We can do the other some other time. I'm all for it because I got more.
Let me tell you, you will trust me. If there's anything we've learned in the last 90 minutes, you will have a chance to talk. Okay. Let me get to the end of this. Okay. I promise. At the end of my homework, at the end of this process, I don't want to pay the legal fee because I agree with you. There is friction in that process. Okay. And we now have this bearer token that doesn't have a $3,000 ish. Let's call it. I mean, I've done equity purchase agreements for what? It's like $3,000. Is that about right?
I'm just thinking it's not the actual, to be clear, that's not the equity purchase agreement. That's just the fee for a single signature as part of the overall transaction. The actual fees are much higher, but keep going.
Okay. You pay a lawyer at the end of this process, usually a lawyer who represents you has your interest in mind, and there's a company attorney who has their interest in mind. And you sign a document, usually at the end of this, you sign a legally binding contract that's covered by U.S. case law, blah, 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 that shows that I own the equity interest in this LLC, that the company has agreed to sell it to me. There are a bunch of representations and warranties in this document about the company saying the things they've told me are true, that blah, blah. Like there's a bunch of stuff. Just let me finish. There's a bunch of stuff in this legal document. I can show you a copy. I'm sure you've seen 1,000 that says I now am taking possession of the ownership in this LLC. And that document is legally binding. It allows me as a purchaser of this to sue the LLC and potentially, the individual who represented that this was, okay. That is how this transaction works today. and it's how it's worked for a long time. We definitely have switched from paper to digital signatures. Thank God. It was really annoying to do the FedExing. I totally agree with you.
And that was legal precedent had to be built for that.
It's not really legal precedent so much as like
There was.
the attorneys had to agree that this was like an acceptable signature.
Well, no. There literally had to be lawsuits about it, and it had to be decided as case law that digital signatures were acceptable.
Sure. But there was still a document.
Same thing.
There was still a document. And now what we're saying is at the end of this fairly long process, you can disagree with me that it's long, but at the end of this fairly long process that requires a whole bunch of manual steps and work that introduces friction because I actually want to understand what this company does and that it's real and the person selling me this stuff owns what they own and like is who they say they are, leaving the crypto thing aside for a second. Then I make a transaction at the end. And yes, there is a fee associated with that transaction. I totally agree with you. It is a little annoying. It's lawyers charging fees. I agree with you. I have one in my inbox right now. I'm going to sign it. It took me maybe 3 hours. Now, just this legal part of it, not the diligence. The diligence took a lot longer. What we're saying is that last piece that we want to be able to like freely transact back and forth and not have to do this legal document over and over again, even though a normal, regular, thoughtful investor should want to do all the steps up front anyway, no matter what. It's nothing to do with crypto, right? Like they would like to They would like to understand what this business is and how it works, and doesn't have to be audited financials. It could even just be like an Excel spreadsheet. There's some stuff they want to do before they make a purchase of this private company that isn't regulated and doesn't have all the SEC rules and like all the other stuff, because it's a private business and the US allows us to do this. So you probably want to understand it. At the end of this process, what we're saying is that I want to be able to do is like instant transaction liquidity, right? Be able to like move my share, my digital version of my share in this company around, and I want to be able to sell it and speculate on it or trade it. Don't use the negative word speculate. Now,
I think SBF uses price discovery. I think that's what you want to do.
Cool. Fine. That's a fair statement. Although you can do price discovery in like a normal auction. Anyway, however, the transaction fee is annoying. So in order for me to add this like final piece of liquidity, the whole end of this giant transaction, for at least the ones I can think of off the top of my head and I haven't like gone crazy yet. One is obviously this custody issue, and then the insurance that I have to pay on top of it because of the custody issue, because it can be stolen and lost. I agree. It's rare-ish. And like, yes, I probably can self-custody it if I was like, crazy. And then a normal person would probably want to use a bank or some third party. I'd probably want to insure it. There's a whole bunch of fees associated with the fact that it can be stolen because the risk of a bearer asset is like pretty big. So there's insurance. It probably comes all the way back to the legal fee I just paid anyway. And what we're saying is it's unsettled. This is the part I've been trying to say for 45 minutes. And it's unsettled case law about whether I actually own anything. It is unsettled case law about whether I even own this thing, because we have to go and like work it through the court system, and the courts have to look at some digital token transaction, and somebody's got to sue. And then there's going to be a whole bunch of rules about what is a digital transaction, what is it. And we want to do this entire thing. And I'm going to take on the risk that I actually might not even own it.
Okay. Are you done? Because this has been like a 10-minute closing statement.
That's the bull case for liquidity in private companies, because all the other steps have nothing to do with the blockchain.
Look, I really have to go, but I would like, that was a long closing statement. I would like to kind of just say, can we scope out for a second? I think we're on the same page after a lot of back and forth that A, liquidity is fundamentally valuable, and B, the vast majority of wealth in the US and assets in the US are held in highly liquid forms, right? That's an opportunity. I think I am with you from prior things you've said that in theory, the idea that you can have a Fed server or somehow Carta has an API and subsumes the whole world into one place, that if that weren't going to end up being a disaster long-term for a whole bunch of reasons, which I will not rehash, right? That it is not necessary to have crypto to do this, but I'll tell you that protocols are way better for it. I agree with you that if you want to make an investment, the diligence, deciding what you want to invest in, your strategy is important. It might not be with the company. There's this idea that it has to be some of the company. I think you add a lot of things in to try to make a stronger point, which aren't true. We'll set those aside. The thing that I believe very strongly, and I think crypto is an incredible candidate platform for, right, is what is a very high transaction fee, right, of saying I actually want to buy something, right? I want to buy something from a bunch of holders. I don't know who they are. I don't know who holds what or what their interests are. The price discovery component, it's not just about the $3,000 transaction fee, although that is annoying. It's actually very high transaction fees. It's the broker fees you currently pay. It's all the middlemen you're actually having to pay in the middle, when all I want to do is buy some shares from Logan or sell some shares to you, right?
What middleman?
Oh, you really asked.
I'm asking what middleman. I'm asking what middleman.
There's a lot of setters. I mean, I could name 6 middlemen I use right now for selling private stock.
You mean like a broker to list it, right? To be able to like find a buyer.
Zach, please, Zach, I really do have to go to bed, so I'd like to finish and let me have my space because I gave you yours. When you get down to the end,
now I feel like I got to do it to you because I just want to like let you see what it's like, but I'm not going to.
Zach, your 2 big arguments is one, the $3 wrench attack argument, which is that self-custody is scary. People won't want to do it and there's fees associated with custody. Fine. I give you that having people the option to insure things and custody things, that there's no reason to not let people do that. I think the fact that the fundamentals is not baked in the protocol is very powerful and interesting and will create efficient markets for that stuff. Your second argument is something along the lines of, I mean, how to even put it? It's like, this isn't that big a deal, I guess, right? And I'm just like, I just think that that's just really myopic, right? In the end of the day, the ability to create a market for private stock, right, in these companies and create liquidity can be a massive engine of prosperity, right? We have tons of businesses in our portfolio that are solely based on the fact that businesses are illiquid, things like team shares, like, et cetera. There's a huge, and so I'm very excited about that opportunity. Crypto is not a panacea. It does not solve everything. You and I agree on that. Like, human institutions matter. But I think that your arguments on those fronts are weak. And then the last thing I'll just add is like this whole settled case law thing you keep coming back to. Again, we talked about digital signatures and the evolution there. Case law changes. It is a risk. There's a risk, right? That like for some reason, some court rejects something and these transactions are invalidated and it's a mess. I totally agree with you. But I think it's extremely slim. And I think part of progress is being willing to like push the envelope on what these things are with good foundational grounding. But again, if you never did anything in business because there isn't quote unquote settled case law on it, right, then like nothing would happen and we'd still be signing wet signatures, right, and sending them along via couriers on bikes in New York, right, and we wouldn't be able to use DocuSign. And if you don't believe that that's annoying and a meaningful difference, like, I don't know what to tell you. So that's kind of my piece.
Thank you guys for doing this and bearing through. So that'll do it for the 27th episode of Cartoon Avatars. If you made it this far, thank you for sticking with us as we got through the episode. Also, thanks to Josh Wolfe for coming on, Sam and Zach for being nothing if not entertaining. I guess a little bit of a programming note as well. We had mentioned that we were going to do, I guess when I got going, we said we were going to do 4 weeks and then see where we were. And then I said we would do 12 weeks and see where we were. And that was where this kind of new framework evolved, where it was just me and ultimately me and Zach. And then I committed to do 26 episodes. So I guess we've officially crossed that Rubicon. We're now at 27. So I think we're going to keep going. I'm not sure exactly to what end. I think we'll probably commit to do another 26, kind of take it to 52 and then sort of see where we are. But thank you to everyone that has listened along the way, supported. All the kind words are super appreciated, and look forward to seeing everyone again next week for the 28th episode and hopefully at a minimum through episode 52. So thanks everyone for listening.